are talking about what does the landing look like. I'm looking backwards at 2022 and saying that looked like a landing to me.
The market collectively does not have a clue at this point in time. Hence, we're going to get a choppy market.
We're seeing the beginnings of a regime shift back to a point where interest rates matter.
We are moving back both in growth and inflation to what we would refer to as the old normal.
Disinflation is not a concept that is dead. It may be around the corner.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Remember the good old days? The disinflationary process had started.
It's transitory.
Yeah.
The risks around inflation were becoming more balanced.
Yeah, what happened?
That was a month ago. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Futures positive here by 1/10 of 1%. TK, we're back to looking at inflation in places like France, in places like Spain.
This has been terribly reported this morning. For America waking up, it's not transitory. Spain and France, and particularly France, the vector is ugly. The vector is not disinflation. Even worse, talk about transitory. John Ferro in the vegetable bin at Tesco or whatever the grocery stores are in England,
it's gone up.
17%. I don't really understand the 17% statistic, but easily 8 or 9% food inflation in the United Kingdom.
Things are moving in the wrong direction, and yields are higher again this morning on a German 2-year up by 6 basis points, 3.1%. Worth pointing out, at the beginning of March 12 months ago, negative about 70 basis points at the front end of the German curve. And Lisa, now, we're not talking 3% of the ECB, we're talking 4%.
I'm so glad you said that. I saw that, and I remember when everyone thought if they raised the rate to 1%, that all of a sudden you'd see this massive implosion of the entire debt market in Europe. And now we're talking 4% overnight rates over at the ECB, and you're not seeing spreads uncontained in Italy. So here's the question. Can they execute this? And is that going to be enough? Do we understand where central banks have to go to contain inflation that has been a lot stickier than people thought?
Welcome back.
Thanks.
It's good to see you.
It's good
you
to be
seem
back.
excited to be back as well.
I'm excited to be back. How long
Just to get away from the family. This is good. Good morning to you.
Don't let anyone hear.
They're not up yet.
Yeah,
Equity
true.
futures positive 1/10 of 1%. Let's whip through the price section for you in the equity market and in bonds as well. In the bond market, a lift in the US too, up by a couple of basis points to 393.17. In the FX market, euro dollar just about clinging to 106 as we close out the month of February, Tom. What a range for euro dollar. A low of 105.33 in the last week, a high of 110.33 when the ECB last met.
I'm going to go with the yields higher again. And again, we've got a more restrictive Bloomberg Financial Conditions Index, positive 0.15. We'll get to that in a moment. But I think the bellwether today is if you've got cash, get rid of it. And Chevron, what we're doing there, folds into every story we're talking about. And what I would suggest is here's somebody with a 10-year track record of 7.1% per year. You know, you look back 10 years, big oil's not doing all that much, but the free cash flow in this surge, John, is extraordinary, and it folds into everybody watching the show this morning in corporate America. How do they respond to this buyback frenzy?
The stock is up by more than 1%, Lisa, as you know. Given that you've spoken to Mike Wirth in the last couple of months, the previously planned rate was $15 billion. That's going to go up to $17.5. And I imagine the White House might have something to say about all this too.
I have no doubt they'll come out and say, why not reinvest it? Why not start more production? And Chevron's going to say, we're doing for our business. We've been doing for our business. And you know what? Why aren't you saying this to others? And you're going to hear that kind of tone. Oil majors in general have been returning so much cash to shareholders, regardless of some of the pushback that we've been seeing. Talking about earnings and companies, Target releasing earnings this morning. They're holding an earnings call at 9 a.m. in New York. Here's a question that I have. What do we see with respect to inventories? That was a big problem. And do we see the same kind of guidance that we saw from Walmart in terms of the year ahead outlook? What is the audience for Target, right? So this is going to be the real question. Are they going to capture the lower end shoppers that are going to Walmart, or do they still continue to benefit from the discretionary items? At 9 a.m., the housing market, this will be very interesting. A number of price gauges coming out. The deceleration expecting to continue, which is a good thing. However, yesterday we saw home sales actually increase, pending sales, surprisingly to a much more significant degree. Are we seeing a reacceleration as mortgage rates comes down? This is sort of the real conundrum for the Federal Reserve, that it's just kind of stickier than they feel. And at 2:30 p.m., Chicago Fed President Austin Goolsbee, who is a voting member, is going to make his first public appearance in this role. He's giving a speech in Indiana. This is going to be really key because this is someone who does have a vote on the Federal Reserve, on the Open Market Committee. And he might give some guidance. Well, does he think that 2% really is the optimal end rate for inflation? Does he give some guidance of how quickly he thinks inflation could potentially come down, John?
Great to see him in that seat. Lisa, thanks for that. Thank you very much. Joining us now is Margie Patel, Senior Portfolio Manager at Allspring Global Investments. Margie, we have to begin over in Europe. Eurozone CPI out in a couple of days. France and Spain, upside surprises. What's your take on that this morning?
Well, we can see inflation is a global phenomenon. All the developed countries flooded their economy with money during COVID to try to stimulate the economy back. And we're really seeing the effect of this tidal wave of cash that came in by the sustained period of high inflation. So nothing the Fed is going to do short term is going to bring that down to 2%.
Margie, you are acclaimed for traipsing between fixed income and stocks, dividends, and share buybacks when the mood prevails. Have you ever seen, as the Wall Street Journal brilliantly sums up today, the $1 trillion moment we're having right now of buybacks, including this morning Chevron? Have you ever seen this?
No, because I think this is one of the best positions corporate America has been. Their balance sheets are clean. They've been very profitable. Profit margins have held up. So it isn't surprising we're seeing a lot of buybacks where they don't want to reinvest it, which is the case in the energy industry.
But isn't also the question here the taxation of dividends, and the arch reason is a tax shield?
Yes, it is. Yes, it is. So I think they'd like to do that right away and return that money to shareholders.
Do you personally like it when companies buy back their shares? Is this a reason to go into the company, or is this not? Because it means that investment necessarily isn't going toward expanding the business in other areas.
Well, I would always rather see a company invest wisely rather than buy back shares. It's kind of sad, really, to say they have a high return on invested capital and the best use of their money is to simply reduce the size of their business. So I'd rather see companies that are investing their extra cash flow and improving the business, really.
Right now, how optimistic are you that we have seen, if not a bottoming out, some sort of feeling that the optimism for the economy outweighs some of the gloom that we could potentially see down the line?
Yes, I think the economy is surprisingly strong. The reason I say surprising is because we had that 4+% increase in short rates last year, and the economy, inflation is up, unemployment is really very, very down, and so that says to me there's a lot of strength in the economy, particularly because this cycle, when the Fed started tightening, there's no sector of the economy that really is hurting, is really way over levered, is really in trouble that might pull down the whole economy. So basically, things look pretty good.
Margie, at the margin, that could be the name of your boat, Margie. Margie, when you look at the migration between fixed income bonds and quality equities, which way are you tilting right now? At the margin, which looks more attractive?
I still think you have to go for equities, even though we may see a pretty bumpy year, because interest rates are rather low for the rate of inflation, and yield spreads are rather narrow. So if we have the Fed raise rates more than people are expecting, you could see some negative price performance in the fixed income market. So I don't think those yields are as compelling as what we see on the equity side, really.
So, Margie, you don't think it's the year of fixed income, the year of the bond?
I think for the fixed income investor to get a yield, say in high yield, of say 6.5% to maybe 8%, is pretty good. But I think equities will do at least that well. And if you're a little bit more patient, I think a lot better over the next couple of years. Yeah.
Interesting. Margie Patel there of Allspring Global Investments. Doesn't think this Fed clearly is sufficiently restrictive. Thinks they've got more to do. Mike Gapin thinks that as well over at Bank of America. He published in the last 24 hours. And here's the quote from him for those of you that would like to follow his work. A big slowdown in consumer demand might be needed for inflation to return to 2%. He said this could require several more Fed hikes. This will likely lead to recession, Lisa, because the non-consumer sectors of the economy already look soft. Mike Gapin of B of A.
He's not alone. A lot of people are gaming out what a 6% Fed funds rate could look like, which sounds unheard of based on what we saw 2 months ago in the immaculate disinflation, and suddenly is what people are putting back on the table. We don't know what's required to bring inflation down. And I think that you are right to point out this long and variable lags isn't cutting it for a growing number of people.
6 might sound foreign at the Federal Reserve. I tell you what, 4 at the ECB, Tom. sounds even more foreign.
I don't
to
understand
me.
the
Four
ECB.
at the ECB.
Foreign is the right
From
word.
negative 50 basis points, we're now talking 4% potentially.
I'm an old fogey on this. I don't think they've got the underlying nominal GDP to withstand that shock. I'd love to be proven wrong on that, to the spirit of continental Europe. What I would focus on, John, is this idea of disinflation, the dynamics on the screen, and the one vector that's not given away is the real yield. The 10-year yield has just crept up for 8, 9, 10 days in a row. It's quiet, but it's there.
Traditionally in Europe, you'd focus on the spread between Italy and Germany. And I have to say, it's not threatening to break the wides of last year. But if you just focus on that and just on that and nothing else, you'll miss the fact that the whole of the fixed income universe across Europe, Germany, Italy, Spain, France, there's just a lift, Lisa. There's just a massive lift.
But it is globally, right? And so some people would say it's warranted because you have higher inflation. You're seeing something that seems controlled and explainable. The fact that you're not seeing a peripheral breakout means that there isn't going to be the same kind of dissent among ECB members and among some of the member states to fight inflation and make that the premier concern, because they're dealing with it too. I mean, this is unique. And I just wonder what the consequence is with all these central banks raising rates, why we haven't seen a more significant long and variable.
Why we haven't seen things break as well.
I do
fixed
wonder
income
about that.
in
It's kind
Italy
of shocking.
and elsewhere. It's amazing. We're going to spend this morning talking about the CPI data out of Europe. We'll get a read on Germany tomorrow. We're also going to talk about this buyback over at Chevron. Warren Buffett over the weekend in his investor letter. When you are told that all repurchases are harmful to shareholders or to the country, or particularly beneficial to CEOs, you are listening to either an economic illiterate, Tom, or a silver-tongued demagogue. Just bear that in mind. We might hear some complaints a little bit later.
You nailed this, John. And what was so interesting here about Mr. Buffet, and thank you, Doug Cass, so much for emailing me on the wonderful Henry Singleton. He's the guy that invented this. Buffett worshipped Henry Singleton of Teledyne. I'd forgotten his name. Thank you, Doug Cass, for sending that to me. He was at Teledyne. He was out of the Naval Academy, electrical engineer, and he said, do a share buyback, but do it when the shares are cheap. And that's what Buffett, that's the nuance here that we're talking about. Is Chevron cheap?
Coming up shortly. A little bit later this hour, Chris Ferrone, looking forward to that conversation. In the next hour, Whaley of BlackRock, fantastic conversation in the 7 o'clock hour, about 50 minutes from now. And coming up next, Bloomberg's Anne-Marie Jourdain down in Washington, D.C. Futures positive by 1/10%. Bramo's back. That's a beautiful thing.
It is a beautiful thing.
It's a wonderful thing.
Glad to be
Welcome
back.
back.
Thank
This is
you.
Bloomberg.
We're gloom-free there.
Keeping you up to date with news from around the world, this is The First Word. I'm Madison Mills. A surprise inflation report today from France and Spain, both seeing prices rise in February. Consumer prices in France jumped by a record 7.2% from a year ago. Meanwhile, Spain's inflation rate hit 6.1%. That will increase pressure on the European Central Bank to deliver more of those interest rate hikes. And for the first time, markets are pricing in a 4% peak rate from the ECB. And Hong Kong is ending one of the world's longest mask mandates after 945 days. Hong Kong leader John Lee says the city has completely returned to normalcy. Shares of companies linked to tourism gained on the news, and this comes after the past 3 years of global isolation have weighed heavily on the city's economy and global standing. And here in the States, the Supreme Court hears arguments today on President Biden's move to forgive the student debt of more than 40 million people. Republicans contend that the president is overstepping his authority on the move. Biden put a freeze on federal student loan payments on his first day in office. And in Ukraine, President Volodymyr Zelensky says the defense of the besieged city of Bakhmut is quickly running out of options. But Zelensky stopped short of announcing that his troops would pull out. Last week, he said that Ukraine would not defend a Bakhmut invasion at any cost. And Chevron is showing confidence in its ability to generate cash even after a 30% decline in oil prices. The energy giant will repurchase the stock at a rate of $17.5 billion annually, starting in the second quarter. Previously, Chevron had planned a $15 billion buyback rate. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Madison Mills. This is Bloomberg.
As we mark 1 year since the beginning of this full-scale invasion, the message I bring you from President Biden is simple. America will stand with Ukraine for as long as it takes. We commend your ongoing focus on the importance of fighting corruption and President Zelensky's goal of strengthening accountability and good governance.
A surprise visit to Ukraine from Janet Yellen, the US Treasury Secretary there. We'll pick up on that story in just a moment. Let's pick up on the price action. If you are just tuning in, good morning to you. Equity futures elevated by not even 0.2% on the S&P 500. A little bit of a lift to close out the month of February and looking to close out the month with a month of losses. In the bond market, yields higher, materially so through the month so far, of 2 basis points on a 10-year this morning, 393.76. Yields much higher over in Europe on the session off the back of hotter CPI out of Spain, out of France. A read on German inflation comes tomorrow. The euro marginally stronger here, Tom. Euro dollar 106.15.
John, thanks so much. And we'll continue to watch this. John, the inflation story to me, I think, is just underreported today. I think it's just a huge deal.
We were hoping it would go the other way. Tom, you remember those central bank meetings
right
back to back? You had Chairman Powell on the Wednesday turn around and say the disinflationary process had started. The following day, you had the ECB President Christine Lagarde saying the risks around the inflation outlook have become more balanced and the data is just pushing aggressively in the other direction.
And we'll have to see on the data today. We get to, is it tomorrow, John, is ISM? Today we've got, as Lisa mentioned, a little bit.
Next up, I think, for this market is German CPI coming up tomorrow, and then Lisa, the ISM in America on the US side of things.
Which has continued to surprise to the upside, which is a negative.
Right now, on Secretary Yellen in Ukraine, Anne-Marie Horton joins us. She's Bloomberg's Washington correspondent. I think the nation, Anne-Marie, needs an explanation of this. I get that the head of the Pentagon, I get that military officials, I get even that the president shows the flag in Kyiv. Why is the Secretary of Treasury there?
Well, she's there to mark the one-year mark of Russia's invasion of Ukraine and reiterating Biden's statement, but she talked a little bit more about this financial aid. So it wasn't just about the military. And what she was talking about is that Americans need to know that it is money well spent. And to the Ukrainians, she's talking about the fact that, yes, there is this defensive in the East, but also that they need to make sure the country is running in terms of everyday provisions and items and things you do, like going to school, making sure there's infrastructure. So that was really her message. It was a little bit different than obviously the one the president made, but clearly the U.S. wants to show a full sign of support in Ukraine as Russia, as they mark this 1 year of Putin's invasion.
Are the allies on board with this and that they will send finance ministers?
Well, listen, over the course of the past 12 months, you've seen a number of leaders around the world show up. I mean, most notably to me over the past 72 hours was Prince Faisal, the Saudi foreign minister. This is the first Saudi official to visit Ukraine in some 30 years. And as much as this was an olive branch to the Ukrainians, they were, talking about MOUs for energy and humanitarian aid. But this was a huge olive branch to the Americans. The U.S. was in this quote-unquote review of their partnership. And then yesterday you had Admiral Kirby coming out to the platform in the press room talking about how they welcome this visit by Saudi Arabia. So this, to me, spoke volumes to not just Ukraine, to the United States, but also to the Arab world. This is the first Arab official to go to Ukraine.
As we commemorate and really mourn over the full year of this war that's been playing out in Ukraine, we're dealing with also the aftermath of it and the renewed focus on energy, on oil, and oil production in particular in the U.S. Will this administration have a response to the Chevron buybacks announced this morning? Is there still a continued focus on reinvesting in U.S. production?
Listen, this will certainly, I'm sure, have a tweet from the president or the press secretary at some point today. The administration has lambasted the oil industry for the share buybacks and instead not putting money into more production. This is something also that I think the administration thinks really plays well with their constituents and in the polls. So I'm sure we will get a response from the U.S. administration, and I'm certainly sure that it will not be a friendly one to the oil industry.
Does this administration not like buybacks just in general? I mean, I ask this because there was a story about the CHIPS Act and any money that companies receive from it being used for share buybacks. Is this sort of a overall blanket feeling that it's bad politically?
I mean, it does feel that way. And the president even mentioned these kinds of things, share buybacks and dividends, in his State of the Union speech. So this is something that the administration constantly talks about when they talk about big multilateral corporations. When you're looking at the CHIPS program, Lisa, it's not even just share buybacks. There's also social provisions to it. If you're taking this money from the CHIPS Act and using these grants, then next to your manufacturing plant, you also need to make sure there's some sort of daycare place for individuals that work in the manufacturing plant to make sure they can have proper care of their children. There's also a foreign policy angle to it. Countries of concern, you cannot be manufacturing in a real sense if you take this money. I think what's clear from the administration is we are happy to invest in this U.S. industry, especially when it comes to semiconductors, but there will be strings attached.
Mate, I'm just picking up on that line in the transcript from the State of the Union address from the president on fossil fuels. We're going to need oil and gas for a while. I believe the Republicans then laughed, and then he had to go one step further. What does that mean? We're going to need it for a while. And what do you think that the big US crude energy suppliers are thinking when he says that?
Well, I think they're thinking, we've been telling you this, right? We've been telling many people, especially on the far left of the Democratic Party, that potentially thought we were well far ahead of the energy transition, that we're not there yet. And it's especially difficult when they are reimagining the global energy map with sanctions on Russia. That clip, Jonathan, will probably be played by Republicans going into 2024 as a way to say that this administration was wrong when they came in on their energy policy. I think what the president is saying to the American people is we do need fossil fuels, and we're going to need them longer than many had potentially thought.
AMH, thank you. Great work down in Washington. As always, we'll catch up with Anne-Marie in the next hour. I want to pick up on a line from Secretary Yellen. It was this line here. We command your ongoing focus on the importance of fighting corruption. The United States is committed to about $32 billion of assistance to Ukraine for security, to basically fight this war. Now, Lisa, there is a corruption issue in Ukraine. It's well documented, well publicized. And I think the Secretary going over there, the Treasury Secretary, and essentially saying that pretty clearly to them, tells you the concerns that we still got at home in Washington, D.C.
Oh, it's a political liability on a massive scale, especially at a time when a lot of strategists say that Vladimir Putin, the whole goal, his game plan, is for the West to become divided, lose interest in funding this war, and then going in and just and then taking over Ukraine. So how does this administration fight the potential for corruption to undo what they've done and reduce some of the political power and the political will?
May I suggest that she went for her good friend Kristalina Georgieva to give cover to the IMF on their next tranche of aid. Or Georgieva can go to the assembled and say, look, the Secretary of Treasury is behind me on this. I think there's some theme to that, too, as we go to the spring meetings and the other challenges the IMF has.
Number one issue at the spring meetings for you?
The four nations. You know, it's published here, Nigeria, Turkey, I can't remember the others. It's like a game of Risk, 3-on-2 Central America. I can't keep track. But the answer is they've got their hands full with a select group of nations. I went back and forth with our Buenos Aires office today on peso, now out to 197 in Buenos Aires. The black market rate is 379.
I wonder if they're going to be talking at all at the IMF meetings about the idea that the developed world is raising rates to levels not seen since 2006, 2007. Remember when this was thought to be a huge liability for the developing world? Is there that same pushback at a time when inflation is as hot as it is? I mean, that's going to be a real potential hot-button issue for them.
Let's go ET. The gravity for the United States, the United Kingdom, and other fancy nations is normal. The gravity for EM is like Jupiter. It's like ET squashed down. I mean, you with me here? Stay with me. Come on, folks. Come on. ET
let him carry on.
ET is cute and squashed down because he's on a heavy star, heavy planet.
Okay.
The gravity's bigger, so
that
cellular they squeeze down.
So who's ET?
Who's ET?
Don't ask more questions. I don't think the IMF's leading on anything right now. I think the leadership's all over the place. At the start of the year, it was all about the prospect for global recession, and now it's central banks need to hike more to get inflation back to target. Pick one. ton of retail earnings through the week. It starts this morning with Target. We should get those numbers in a couple of minutes. When we get them, Lisa's going to be all over it.
It's fun.
Wait for that.
I am.
I don't know if Lisa'd call it fun, but Lisa's got a screen up ready to go.
Don't you agree with me? Every story's different.
Sure.
It's
tends to be that way, and they're all
fun.
Super exciting. Okay, futures are up by 1/10% on the S&P to close out the month of February. Pretty dreadful month, to be honest with you. Down on the month by about 2.31%, but really you need to go down from the highs of the year right before that payrolls report on a closing basis. We're down from those highs by about 4.73%. Yields are higher by 2 basis points on the session on a 10-year, 393.95. Off the lows of the year, though, on a 10-year, we're higher by about 60 basis points. Off the lows of the month on a 2-year, we're higher by about 80 basis points off the intraday low of early February. Just getting those numbers right now from Target. Lisa, what do you see?
Well, first of all, a pretty big disappointment for last year. Full year adjusted EPS $7.75 to $8.75 versus the estimate of $9.25. So looking forward, it's a big problem for them, and that is not going to be positive for their shares, which I'm sure are lower on the day. When you look over what they're talking about, they're expecting operating margin to reach low single digits. They're talking, that they expect some of their revenue, but honestly, the operating income margin, they're expecting to go beyond the pre-pandemic rate of 6%. That isn't necessarily creating any confidence. You're seeing those shares decline by more than 5% on the heels of that. I'll keep digging through that and get you more details.
Jen, these are amazing headlines, and the one that comes out, their comp average transaction was 0%.
Yeah.
With this inflation,
that's not going to get it done.
I've never seen a headline like that.
So they give you an outlook, Tom, for the first quarter and a full year. They see the first quarter adjusted EPS in a range of 150 to 190. The estimate was 219. They see a full year adjusted EPS range of 775 to 875. The estimate was 925. Stock's down 4.8%. And if you just go through the previous few quarters on earnings day for this name, Tom, they were down 13% after reporting earnings in the last quarter. They were down 2.7% on the day after reporting earnings in the quarter before that. And you will remember what happened in May 18th last year, when the stock cratered 24.93%. And they're down another 4.8% this morning. They just can't keep out of trouble on earnings day, can they?
Lisa, what do you got?
Well, what's interesting to me is that they beat on earnings per share in the fourth quarter. And we've seen this from a number of companies. It's all about the forecasts, right? That actually in the fourth quarter of the last 3 months of the year, it wasn't bad. It's going to get worse. And that is the message that we're hearing from Walmart, and that is the message that we're hearing from Target.
You look across Meta, Amazon, and all the rest of digital, the layoffs that we're seeing, dribs, drabs, some of the smaller, non-profitable digital firms. Target fourth quarter digital comp sales down 3.6%. That was an unimaginable event 5 years ago with digital growth.
But they're also dealing with some pretty stiff competition. Walmart's been investing really heavily in their digital world to try to compete with Amazon. Are you seeing a consolidation in the digital world that's more significant with Walmart and Amazon, and it's harder for Target to break into? I wonder if there's some idiosyncratic story there, too.
We'll continue to look at this. Lisa's going to dive into it, and of course, she's going to have fabulous coverage of all the other retailers as well. Now joining us, frankly, the interview of the day, given the gyrations of the moment, is Christopher Verone, partner and head of technical macro strategy at Strategas. It is a Baird company. Chris, there are two types of charting. There is stochastic, looking at the jumps, trying to catch the falling knife, and there's trend-based. You and I are on the same page on the efficacy of trend-based. Is there a trend out there right now?
I think there's a dominant trend out there, and we always say trends will trend. Where's the trend? It's in the rate market. I mean, what you've seen over the last few weeks, particularly rates, I counted 22 countries over the last several days that have made new highs with 2-year yields. So you have short rates that continue to surge everywhere we look.
I think we've lost Chris there, Chris Verone at Strategas. I'm not sure he'd want us to freeze on that shot either, because that wasn't very flattering.
That was not very flattering. We'll try to get him back.
Try and re-establish that connection for you.
5:30.
We got Target earnings about 4 minutes ago, so let's go through them again. They offer a range, a forecast for the first quarter and the full year. An EPS range is 775 to 875 for the full year. The estimate was 925, so that's below expectations. The first quarter, a range of 150 to 190. The estimate was 219, so that's below expectations also. Stock a bit softer in the pre-market. No real drama, though. It was down about 5%. Lisa, it's now down only about 1%.
But I'm looking right now through all of the earnings. It was pretty weak. And looking at comparable sales in the fourth quarter, it was up 0.7% versus the estimate of a decline, but versus 8.9% year over year. I mean, this is basically what we're looking at right now. And I think that what you're looking at is a company that's struggling with the same headwinds as others, and yet with perhaps a weaker footprint than the ones that have consolidated a lot of the power, like Walmart and like Amazon.
Is there a macro story here?
It's a good question because they've dealt with inventory issues in the past. Is that really the hangover of that's coming to the fore in some of these numbers? I don't know. The 9 a.m. call Eastern time from this company will be really instructive when it comes to that. How much is just a planning issue versus a macro issue?
I think, Tom, you raised the right question. In a high nominal GDP world, posting flat sales growth, perhaps not the one.
Well, it shows a challenge here, and Brian Cornell, I think, nicely addresses that, as he always does. He has two companies he's doing. He's got household items, beauty products, essentials, the stuff, food even at Target. They do a little bit of a food business as well. And then they've got this thing that they call discretionary categories. And people are not being discretionary with their discretionary spending because they're spending it on rent.
Well, it's funny you mentioned that, Tom, because discretionary is outperforming on the S&P 500 this year. Yet today, discretionary is doing really, really well.
Full disclosure, with the few years I've had at this, I've never been comfortable with the word discretionary in sectors. In the Sam Stovall world, I've never been, I just don't, I've never gotten it. There's toothpaste. Is that discretionary? I don't know if it is or not. Is a bow tie discretionary? No, it's not.
Yes.
On and on. I hate the word.
Discretionary is... Bow tie absolutely should fit under that category. Might be a staple for you. It's very personal. I agree.
Tang is not discretionary.
But, it's actually a good point, and not necessarily about the bow tie. But when it comes to discretionary, how much are we looking at the resurgence in travel and experiences as supporting the discretionary spending while
the
other
casinos,
exactly,
the
versus
cruises,
and maybe
those crazy people that get on boats for a week. Those
you feel
people.
That bad. We're gonna do
the
that
airlines
too.
Are doing
Surveillance
great.
cruise. We're gonna resurrect that.
We're not. The idea of being stuck on a boat. No.
With us?
With you guys, absolutely. You're like family to me. I've got no problem with that at all. With strangers, no. I can't. No.
Well, we're going to do the surveillance cruise.
So many people have heard this rant before.
I
We
know.
don't need to do it again.
Okay.
I'll save you. TK?
I'm still in shock that we have Mr. Verone back. Very good. Let's go to Christopher Verone now with Strategas and the Baird Company, who I believe is joining us by telephone right now, which is good, given he has 8 inches of snow to the north of New York City. Mr. Verone, you mentioned that there is a trend there, and it's a challenging trend. We dovetail it with Target, which we can all agree is a well-run company. What sectors show signs of life? What sectors of the equity market can we be comfortable owning given the moment?
Well, I think, Tom, what's notable here is how the market, despite a very good rally off the low, I don't think we should call this move monolithic at all. And there are certainly clear areas of strength, and there are also clear areas of weakness. On the positive side, I think we have to continue to tip our hat to the strength we've seen from the industrials, and not just domestically. I mean, the industrials, whether it's in Europe or Japan, the machinery names have been absolutely fantastic here. I think they're telling us something. Leadership last year in a difficult year, and also leadership so far this year in an up market, that sounds like something that is trying to communicate some secular story to us. So I really want to respect the message from industrials here.
So what's the message and how do you trade it?
Well, I think intellectually we could all come up with something, right? Perhaps it's reshoring or onshoring or any number of things. What I'm more concerned about is you have big machinery stocks from every geography around the world that really haven't worked for the better part of the last 7, 8, 9 years coming out of these multi-year bases, whether it's Japan and Komatsu, whether it's the U.S. and Parker Hannifin. We've been using this acronym EPIC, Eaton, Parker Hannifin, Ingersoll Rand, and Cummins Engines, EPIC. I think that's going to be a more important acronym than FANG over the next number of years.
So when somebody asks you, does that mean buy or sell? What do you say?
I think there's some pretty epic leadership that's coming from this industrials group. I like them all.
Chris Verone, suffering with the snow in Darien, Connecticut. Hey, Chris, we appreciate it. Thank you, sir. He was meant to come in, and then he couldn't make it in.
He's not suffering.
He's got 8 inches or something.
It's 8 inches. A lot of the upstate New York and Connecticut areas got
Where was
that.
our 8 inches in Manhattan?
We were supposed to get, we didn't get any. Right. So last night, the boys, were counting snowflakes. They were like, please let there be a snow day. Please. There's not going to be a snow day. 2.5 inches doesn't do anything and it's melting. And they're like, it's not melting, it's sticking. Look at that car. I'm like, it's not sticking.
Do you get snow days in the era of Zoom for these kids after the pandemic? Has the pandemic killed snow days?
Yes, but we had this discussion, right? Does it matter if you have to do school via Zoom? And basically what it comes down to is school via Zoom is not school.
Oh.
And so it's better than having to go to school because then you don't have to get dressed.
They're not participating.
Didn't you see all those videos of people who would say, like, pretend the screen froze and then there'd be like cats moving behind them and things like that during the Zoom era?
Put a free shot there.
Exactly.
Love that. Love that.
And people in the snow belt will understand this, is that we prayed there wouldn't be a snow day, because if there was a snow day, you were at home and your father was such a hitter that he had a driveway that was like, you know, a road. It was so damn long, and he'd hand you the snow shovel and say, start at the street.
Yeah, city kids don't have that.
You'd pray that there wasn't a snow day.
England was amazing for this. You got a little bit of snow and the whole country shuts down.
Really?
We're just guaranteed. Yeah, you don't need 8 inches. You need you need a couple of centimetres of snow.
Is that
game over?
Wait, is that true, or is that just the Ferro household?
No, I mean, we used to embellish things a little bit.
I've witnessed that. No, I've seen
but in the UK, leaves on the railway line. That's the thing.
Well,
just cancel train.
It's cancel show. Well, that's what happens down south too, because they're not prepared for it. They don't have the big, inventories of salt and everything. And I told the kids, I'm like, no, just because it hasn't snowed this season doesn't mean you're going to get a snow day. But look, Mom, it's collecting.
Are they taking a day off or no?
They better not be.
Slippy sidewalk. They
give me a break.
You've got to stay safe, Bramo.
Vortex.
It's important.
Vortex.
Futures right now on the S&P, positive 0.2% as we close out the month of February. We get a little bit of earnings for you from the likes of Target. A little bit softer off the back of earnings, a cautious profit forecast from the company in the face of what is still high nominal GDP, given what we've got in this country at the moment. Discretionary goods, demand there, not great, as you pointed out, Tom, at that company. Yields are high this morning as well by 3 basis points on a 10-year, 394.54. Over in Europe, they're a whole lot higher, particularly in Germany at the front end, high there on a German 2-year by 5 or 6 basis points on the session, 3.13%. Hotter inflation in France, in Spain. It's Germany's turn tomorrow. This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Madison Mills. The Biden administration has a warning for companies lining up for funding from that U.S. CHIPS and Science Act. The money will come with major strings attached. There will be restrictions on investing in other countries and a limit on stock buybacks. The $39 billion in incentives are meant to boost semiconductor factories here in the U.S. And Fox chairman Rupert Murdoch testified that Fox News commentators endorsed false claims that the 2020 presidential election was rigged. That's despite Murdoch's immediate doubts about the conspiracy theory. Murdoch was questioned in a lawsuit against Fox by Dominion Voting Systems. Fox has denied it promoted false claims about the vote. In China, media regulators are looking at ways to curb, quote, excessive video use among young people. No companies have been named, but short-form video content on platforms like TikTok has exploded in popularity. Regulations that restrict viewing time for minors could impact big tech giants from Tencent to ByteDance. And in the UK, home buyers are getting their best discounts in more than 5 years. According to the property portal Zoopla, the average reduction to an asking price this month was 4.5%, and it was just 0.4% last year. And shares of Zoom are higher today. The video conferencing platform gave an upbeat profit forecast for the current quarter. The outlook suggests that Zoom is finding its footing again after a dramatic boom and bust cycle during the pandemic. A cost-cutting push is helping offset a slowdown in sales. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Madison Mills, and this is Bloomberg.
We have not come to the reality yet that our concepts of demand and supply for labor, for wages, may not work the same way our textbooks told us they did for the last several decades. We know from history, if you make people poor enough, they will have to go back to work. But is that what we should be doing? And is that what central banks should be doing?
What a treat to have Francis Donald back from Manulife. Just absolutely brilliant. A breath of fresh air and asking some really important questions about central banks. When central banks say and use this phrase, we need demand destruction, softer demand, what do they actually mean? Well, what they mean, Lisa, as we know, is ultimately they want unemployment higher. They want people out of work. Now, I'm not saying that they would ideally like to see that, but that seems to be the mechanism that they're discussing when they talk about softer demand and lower inflation.
We were talking about this last night. What's the connection here? What's going to keep people from spending money if they have jobs and if they're being paid more? What is the transmission mechanism? Is it that they have got higher mortgage rate? Well, they don't, because guess what? If you've locked in your mortgage rate, you have the same one. So it shows just that it's very difficult to get inflation lower by the Fed's policy unless you get some sort of reduction in the workforce. And that's really, unfortunately, the byproduct.
Francis said it, Tom. She asked the question, is that what central banks should be doing?
Exactly. That is the heart of the matter. Is it a prescriptive policy to lower inflation? If we do something, we can move inflation down, or is it a greater system off of a pandemic, off of the Biden stimulus, frankly, the global stimulus that has to be worked out over time? The insight yesterday, Lisa, you weren't here, was the Taylor rule disparity that we see. I've never seen a modeled Taylor rule, which can, folks, everybody's got a different model, but it's up here and inflation's down, the Fed's down here rather, and that gap is bigger than it was at the heart of COVID.
Maggie Patel alluded to that.
That's how out of whack we are.
Yeah.
I mean, we're massively out of whack, and that's where you fall back on individual data, which you do in securities analysis. He's out of Tufts University in Boston. Michael Baker joins us, really quite good at D.A. Davidson on the core of what retail's doing. Michael, I usually don't do this, but I'm going to go LIFO, FIFO on you, which, you and I studied in school. LIFO, FIFO is back, and that means inventory's out the door. Target's one of the best run machines we have, the Swiss watch of inventory management. What are you learning about all of retail's inventory agony from Target?
The retailers have done a really good job in 2022, realizing that they made a mistake and working through it. This inventory issue really hurt a lot of retailers in 2022. Just about a year ago, everyone was bulled up and they got really over assorted, particularly trying to bring in inventory early in front of the supply chain issues that we had last year. And everyone just got over assorted. That was a big problem, but the retailers realized it quickly, right around March or April of last year, and aggressively moved to mark it down. And it was a tough year for a lot of the retailers, but I think they got it done.
You make clear in your note, you look at it as a pandemic one-off, and that Target and others will return. You raise your price target on Target a couple days ago, price target on Target a couple days ago. I got that out. But Michael Baker, what's the timeline where they clear the inventory challenge? Is it now? Is it into 2024?
No, they did it. Their inventories in the quarter just reported as of this morning were it was either up or down 3%. I have the press release right here. It was essentially flat, 3% down 3% at the end of the fourth quarter. At the end of the third quarter, we were up 14%. Mid-year was, I think, 35 and 45% growth. So they really succeeded in clearing out those inventories, and they start 2023 clean.
Michael,
so that inventory issue is now behind them. It's no longer an issue.
I was looking at some of the headlines as they came across after the earnings dropped, and I was pretty confused. They seemed pretty negative, and they also seemed kind of motley. Looked at an earnings drop, a profit drop of 43% in the fourth quarter, a forecast that came in under expectations. The shares are now higher by 4.6%. Yeah. How do you make sense of this?
Yeah, doesn't surprise me for two reasons. Three reasons you keep in point to. One, this is exactly what happened with Walmart last week. Walmart reported a beat in the fourth quarter, gave guidance that was below consensus and arguably conservative. The stock opened down in the pre-market and then ended up being up. It's exactly what we're seeing with Target right now. I think the idea here is that margins are going to be better. Margins will hit their low in 2022, and they're going to be higher in 2023. So the analysts got a little bit too high in their estimates. I think the consensus estimate for next year is 5.3. We're at 4.7. They guided to something that'll be around 4.5 to 5 or so. That's up from 3.5 in 2022. So that's a good number. We're growing next year. We're just not quite growing as fast or recovering as quickly as the consensus estimates wanted. But two things. One, those consensus estimates to me are probably conservative. And secondly, we're heading in the right direction. 2022 was the trough for Target. 2023 will be better, and 2024 even beyond that. It might take a little bit longer than the consensus forecasts had, but to me, that's just a function of the analysts getting a little bit too aggressive here.
It's kind of hard for me to get my head around this. Are you saying that the market didn't really believe the estimates that analysts had put out there, that they basically thought they were highballing it and were expecting some sort of downgrade that Target put out there? Or is this Target basically lowballing it to set expectations low and everyone just says, we know what you're doing, so we're going to get ahead of that?
More the second, I think. I think that Target is giving nice conservative guidance. I'm not necessarily saying that they're going to beat it by a tremendous amount, but I do think they're giving guidance that they believe they can come in ahead of by the end of the year. And I think it's the right thing to do at this point. The biggest mistake that a lot of retailers made last year was getting too bullish for 2022, and they had to guide down 2, 3, 4 times. I think Target guided down at least 3 times in the year. The management team's Brian Cornell does not want to do that again. So the estimates that they've given here are conservative. They show nice growth, but they're conservative. That's a positive in both sense, and I think that's why the stock's up this morning.
Well, now it's down. I mean, it's basically been flipping and flopping, and Target's been a lot more volatile than Walmart, and so we'll expect to track that. Obviously, we can't really make a read on the sentiment given some of the volatility. I am wondering, though, whether you think that they've worked through some of the idiosyncratic issues, whether it's inventory that Tom was asking about, or just competition in general on the digital side when it comes to Walmart, when it comes to Amazon.
Yeah, I think they're actually doing really well on their digital business. In fact, they've been one of the leaders in that space in understanding the idea that your stores can actually be an asset for your digital business rather than a hindrance. If you go back 10, 15 years ago or whatever it was, the idea was close all the stores. Stores are hurting the e-commerce business. I think Target understood early that they can use the stores to help supplement that online business. And so really the poster child to me as of an omni-channel retailer. So I think they've done a good job there. Competitive-wise, their same-store sales have actually been pretty good throughout this whole issue. It's right. For them, the biggest issue right now is mix. They are still a little bit more assorted to non-discretionary categories, discretionary categories compared to, let's say, Walmart. And that is why their margins won't grow as much this year as some of the analysts had thought. Still going to grow year over year, but just not as much as analysts thought.
Michael, what's your single best buy then? What has the mix that gets us out 1 year?
Well, in our 2023 Outlook piece, we put best ideas out as O'Reilly Automotive, as Dick's Sporting Goods, and Ulta Beauty. We also put out Target as one of our preferred ideas.
Yeah, Ultra Beauty, Lisa, is...
You're all about it, Tom.
Just very...
Ulta,
that,
not Ultra Beauty. Whatever
it is. Ultra expensive.
Ultra Beauty.
Ultra adds up.
Yeah, Ultra adds up. Do you spend a lot on Ultra?
Oh, we do. What we do is we have a very low price point, but we have many things.
Oh, yeah, they try to do that.
They
little things.
They succeed at doing that.
But when you go to pay, you pick out more. That kind of
and
place.
It's like, $5. It's only $5
is when you get the manse, you don't have counters in girls' bathrooms.
Sure.
That's the pro tip.
Oh, right, okay.
You have
Good luck with that.
No counter space.
That's the professional advice.
That limits the number of units.
I'm sure you live in a happy household, TK. Michael Baker, D.A. Davidson, thank you, sir. Target stock all over the place, to Lisa's point just moments ago. The stock is now higher, Bramo. Hard to keep up with, up by 5.5%. Was lower, as you mentioned, and now it's positive.
Yeah, and it keeps climbing, almost 5.8%. I mean, you just watch it. But what Michael was saying there just then was fascinating. This idea that basically people are rejecting the view that Target is actually more pessimistic than the street, and that they're just guiding it down to basically set low expectations. That's what basically he's saying. And everybody has their gig, and so we know what your gig is.
Gentleman out on Twitter, John, makes me smarter this morning. He's got a fancy Deutsche Bank ad from India. This is the Damien Sassower world. How about a 7.5% 5-year CD with an annualized pop published at 9%? This is not crypto. This is Deutsche Bank. And of course, the issue is it's in Indian currency. So that's, you got an EM risk there, a currency risk there. But boy, has the rate structure changed. I haven't seen that since, I had no gray hair.
Well, high yield is starting to look a little bit more like high yield.
Yeah.
It's been a while. It was always junk.
It's a whole new world after all.
And not India. I'm talking about, say, credit.
Yeah.
Credit here in the United States it's high yield again, finally.
Yeah, and people are going into it because of that, which is the reason why it's becoming less high yield.
here we are talking about what does the landing look like? I'm looking backwards at 2022 and saying that looked like a landing to me.
The market collectively does not have a clue at this point in time. Hence, we're going to get a choppy market.
We're seeing the beginnings of a regime shift back to a point where interest rates matter.
We are moving back both in growth and inflation to what we would refer to as the old normal.
Disinflation is not a concept that is dead. It may be around the corner.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
We should just do a whole hour of people saying, I've got no idea. I don't have a clue.
I think we do.
I
think that every morning
Sure.
people we have no idea.
Live from New York City this morning. Good morning. Good morning. For our audience worldwide, this is Bloomberg Surveillance with Tom Keene, Lisa Abramowicz and Jonathan Ferro. Futures right now up 0.25% on the S&P 500. Plenty of data, Fed speak, all that good stuff through the week. We need to pick up on European CPI this morning. Hot in France, hot in Spain. TK, we're going to read on Germany tomorrow. There is a lift in Eurozone sovereign bond yields this morning.
Transitory further gone. This is the second tranche of hotter that we've had. And, I'm going to go back. People think it's physics envy. It's just the reality of you look at a trend on a chart and there's a vector. The vector on French inflation in no way, shape, or form signals disinflation.
And now all of a sudden we're talking about 4% potentially at the European Central Bank. Try and get your head around that. That is absolutely ridiculous. That's the ECB. Let's talk about earnings here in the United States. Through the week, get a ton from the retail names in America. Target, first out the gate. Bramo, I've got to say, let's put the stock price action to one side. Let's just look at the numbers. The guidance is poor relative to what was expected for the quarter and for the year ahead.
Correct, which is the reason why you'd expect the shares to be lower. They are not. They are higher. And this, to me, is really the question. Are people willing to look past any negative guidance and just say, they're playing a game with us, they're going to try to guide us down, and then they're going to hurdle over that lowered estimate, and we've got your gig, and we're going to get ahead of it and buy instead of just, waiting for the data to come out?
Now that we have Telebian gravity, the math is back to what it was 16 years ago. Just perchance security analysis actually matters. And you just heard that from Michael Baker of D.A. Davidson, who's truly expert on inventory dynamics. And the answer is, I guess, it's up because, as he said, they're clearing inventory.
Well, they had a big inventory problem last year.
Yeah,
on the
and
good
they're
side.
clearing it out.
As you know, it's been difficult for the retailers, that's for sure. That stock is up by about 3% in the pre-market. Let's whip through the broader price action for you. Futures are just about positive by 0.25% on the S&P 500. A lift in the equity market on the session, a move lower on the month as we close out the month of February. We continue shifting higher on a 10-year yield by 3 basis points. Your 10-year right now, Lisa, 3.94.54.
So we talked about the Target releasing earnings, the earnings release. We're also going to be watching the 9 a.m. earnings call that Target's going to be holding. I'm actually more interested in that, especially in light of the share price reaction, considering the fact that have they cleared out the inventory issues? What are they doing on the digital front? How significant do they see the deterioration in demand as the year goes on? 9 a.m. we get a home price data, the FHFA house price data, as well as the S&P CoreLogic Case-Shiller 20-City Index. I know that you love it when I say that, but it's going to decelerate, and that's the expectation. But by how much? Because you're starting to see a bit of a resurgence in some of the housing prices. Are you laughing at the name of it?
It needs a rebrand. It just needs a rebrand.
It's the Case-Shiller Index, but now it's like merged,
go
and
with
then
that.
it's merged.
Someone bought it.
This, and then it's like,
Okay, whatever.
Logic.
All right.
Okay.
It is what you said it was.
2:30 p.m. I am curious about this. Chicago Fed President Austin Goolsbee is going to be making his first public appearance in this role. He's giving a speech in Indiana, and he is a voting member. So let's hear from him. Let's see how far he thinks the Fed has to go. How far away are we from some sort of terminal rate? I think about Torsten Slok's no landing, and he kind of amended the no landing to no landing now and then a hard landing later because the Fed's going to have to raise rates so much. And so how much do we start to hear that kind of view?
It's an important clarification, and Neil Dutta of Renaissance Macro offered one in the last 24 hours as well. It's not that Neil and company are saying the economy's never going to land, the economy's never going to weaken. The original pushback was against the expectation that we would see recession in early 2023, and they were pushing back and saying no, that's not going to happen. And ultimately, the data so far, at least for the month of January, has pretty much confirmed that.
And then the flip side of that, if we don't get that recession, do we get an even harder landing on the other side because of what central banks have to do, a 4% ECB rate, a potentially 6% Fed funds rate?
We get lucky this morning. Wei Lee's with us. Wei Lee, good morning. From BlackRock. Wei Lee, thank you for being with us here in New York City. You came into this year conservative on equities. Mm-hmm. The equity market rallied. You stayed conservative on equities. Mm-hmm. The equity market started selling off. You're still cautious. Can you walk us through why?
I have no clue. just to add to your
we can go to the montage. That works perfectly.
Of things. But the reason that we're cautious on equities is really that if you look at where valuations are, it's pricing in still a very modest kind of growth outlook for the economy, as well as for earnings as well. And if you look at where rates are, as you know, we have been of the view that they cannot cut rates. Now markets are moving closer to our view, but markets are still looking at rate cuts later in 2024. And we think that actually, given how a resilient economy has been and how much the recession will be pushed out later down the line, actually rate cuts also needs to be pushed out further as well. So equity markets in developed world are not quite appreciating some of the macro challenges that we see happening, and that's why we have been prudent. Now, having said that, our time horizon is 6 to 12 months, and some of that metrics that we use to support the cautious view is valuation based, but that is not to say that we cannot have shorter term bouts of rally, which we saw in January, right? Like driven by technical factors, short squeeze, driven by FOMO flows as well. Real money investors are telling us that, you know what, after a year like 2022, they cannot afford to miss the rebound. So they're just going to pre-position for that, even if they know or they fear that it could get worse before it gets better.
In your beautifully elegant note, you talk about a new regime. I'm going to label it a BlackRock new regime. Larry's probably going to go, no, it is. It's a Wei Li new regime. But whatever it is, it's a new regime. If we're not going back to securities analysis and factor analysis pre-2020, what are we going forward to?
Well, the new regime is predicated in terms of the macro drivers of the current environment, that we are moving from the great moderation with economic cycles shaped by demand to the current environment shaped by supply and supply constraint in particular. Factor analysis is difficult because factors are time-varying concepts, and factors can mean different things to different people.
I got to interrupt because we got to do a mathematical clinic here. I mean, right now we've got a Taylor rule as divergent from Fed policy as we've ever seen. If you do the partial differentials of factor analysis, I get the idea it's mud out there. You have no idea visibly where you're going. If you do the partial differentials across any Fed theory now, do they work?
At this juncture, no.
Thank you.
At this juncture, no, just because of how unstable some of the forces are, right? Like, so thinking about, R star, one could see actually it moving temporarily before settling back down, given the kind of environment that we see right now. So as it translates into factors, it's tough to apply the old playbook to factor investing. Like people say, as we head into recession, we got to shy away from value, but we're also in an environment where rates are going higher, and curve, in our view, should steepen over that 6 to 12 month horizon. So we actually think that there is more room for factor value to perform, but we want to be a bit more selective. So we apply a quality tilt to the typical factor exposures.
When you talk about rates going higher from here, HSBC's Stephen Major put out a note this morning where he said the debate in bond markets today is whether to buy and hold short-dated bonds at close to 5% or go for the longer ones, which are almost 4%. And it goes to this belief, are rates going to go higher and stay there for a longer period of time? Or, do you want to capture just what you can get at this point? Where do you fall on that debate?
The former. So we like front end of the curve over the back end of the curve. You take very little duration and credit risk. You get paid. T-bill is paying you almost 5%, and commercial papers are paying you 5.5%. These are very attractive income opportunities. And given our view that actually rates will stay higher for longer, we don't necessarily want to kind of go into the long end of the curve, especially given how inverted curve is at this current juncture. Term premiums should come back. It's underappreciating the degree that we're going to have to live with inflation, and we do want to kind of sit out and bunker down.
When will that value proposition change? When will the long end start to look more attractive to you, or even risk assets start to look more attractive to you than a 5% short-term rate?
I think it comes down to what extent macro damages are being priced in by markets. So the reason that we currently are shying away from developed market equity, we're modestly underweight, is because we don't see the macro challenges being fully priced in. So we're bunkering down in short end of the curve. But if market pricing changes, getting closer to our fair value, that would certainly change things as well. But also, we're actually on a global basis, we like emerging markets. We have an overweight, very modest overweight in emerging market equities. So think of our view currently as almost a barbelling between the short end of the government bond market in the U.S. and emerging market equities on the other hand. Given where the pricing and the valuation sits at this current juncture, the last thing I would say is that this is an environment with very heightened macro and market volatility. We have to change our views very quickly. We've already changed our views twice, and we're still in February this year. So, it's very dynamic.
Can we finish on China? PMIs this evening. How's the reopening going?
We have the view that actually reopening for 2023 should carry growth to something with a 6 handle for 2023. And that is off the very low basis of 2022 with a 3 handle. So clearly things have to be kind of viewed together, thinking about long-term growth trend. But we currently think that the growth pivot that we got a flavor of at the December Central Economic Working Conference actually will be further reinforced at the 2 sessions that are coming up in 2 weeks' time, and the PMI data actually could also give further evidence of that to that growth would come through in this reopening restart dynamics in China. But over the longer term, though, structural growth in China is very challenged. By the end of this decade, we're seeing China growth stabilizing with a 3 handle. So we're talking about longer-term challenging, but near-term restart opportunities that we want to lean.
TK, 6% GDP this year, and then back down to levels like 3%. Invest around that.
Just so you're aware, he's in the final rewrite on the Ferro 270-day outlook. It comes out March 31st.
It always comes down
very
March.
Smart, very
I wait for
smart.
things to go wrong in the first quarter.
Yeah, he waits for you to change your view 3 times, and then he puts out his
I'm not sure that would work if I actually did this professionally, but, it's just what we do here at Bloomberg Surveillance. We wait a quarter. Wade Lee of BlackRock. Wade, thank you. Just awesome as always. Thank you very much. Coming up in the next hour, Sarah Malik of Nuveen. Futures up this morning. Good morning.
Keeping you up to date with news from around the world with the first word, I'm Madison Mills. The Supreme Court hears arguments today on President Biden's move to slash the student debt of more than 40 million people. Republicans contend that the president is overstepping his authority on the move. Biden put a freeze on federal student loan payments on his first day in office. And a surprise inflation report today from both France and Spain. Both seeing prices rise in February. Consumer prices in France jumped by a record 7.2% from a year ago. Meanwhile, Spain's inflation rate hit 6.1%. That's going to increase pressure on the European Central Bank to deliver more of those interest rate hikes. For the first time, markets now pricing in a 4% peak rate from the ECB. And in Ukraine, President Volodymyr Zelensky once again appealing to the U.S. and allies to supply advanced fighter jets for the war against Russia. Zelensky says an attack by drones that killed 2 emergency workers shows that Ukraine needs the jets. President Biden resists sending F-16s because of concerns that this could escalate the war. And Hong Kong ending one of the world's longest mask mandates after 945 days. Hong Kong leader John Lee says the city has completely returned to normalcy. This comes after the past 3 years of global isolation have weighed heavily on the city's economy and global standing. Shares of companies linked to tourism gained on the news. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Madison Mills, and this is Bloomberg.
Equity futures trying to close out a dreadful month on a high. Equity futures right now up 0.4% on the S&P. On the Nasdaq, about half of 1%. What's that? Bring what up, Tom?
I haven't done the drawdown thing recently. I do that. I'm not going to do it right now and slow down the show. But the answer is off the rebound. No, we've had a little bit of a pullback, but still, I'm nicely above the moving averages that I use.
Off the highs of the year,
it's
we're
not
down
the
about.
Worst. It's not as gloomy as Bramo would make it.
Down about 4.7% off the highs of the year on the S&P 500 from the close of yesterday. If you look at the bond market, the moves we've seen have just been phenomenal. The US 2-year yield on the month is up 60 basis points. If you take it from the intraday low, which was the first couple of days of February, the 2-year yield's up by almost 80 basis points. Right now, just short of that, up by a basis point on the session, 479.29 on a 2-year. This whole yield curve has just changed radically from 12 months ago. It's not just in the United States, it's Europe too. Just to see the German 2-year through 3%. And up 4 basis points on the session off the back of hot CPI in France and Spain. Let's finish on the Eurozone. You'll get a read on Germany, German CPI. You'll get that tomorrow. In a couple of days, you'll hear from the Eurozone in its entirety. But based on what we saw from France and from Spain so far, there is a feeling now you will get an upside surprise, a lift relative to what we were expecting just a couple of days ago. Euro dollar 106.10. We're just about unchanged. And TK, I've got to say it, we've gone from talking about maybe the ECB hiking, maybe getting back to zero, then perhaps going to 1, then 2, maybe 3, and now we're talking 4% of the Eurozone.
What does Christine Lagarde do with the unique fiscal structure and national structure, cultural structure of her ECB? To me, I mean, John, you're the expert on this. I defer to you, but to me, it's just a complete mystery because we've never been here. Duisenberg's never been here. Otmar Issing's never been here. Mr. Trichet's never been here. It's truly original territory.
Well, the good news for them is that the risk, if you look at Italy over Germany, the wides of last year were 250. That spread right now is 180. But I don't think that brings much comfort to Italy, who now look at an Italian 10-year of 4.5%, Tom, with the threat of maybe, Lisa, moving even higher than that. I don't think they're going to sit there and say, well, it's good because we're not at the wire to last year. I mean, the fact of the matter is that rates are a whole lot higher.
Are they going to have to raise rates higher, even though longer term it's going to mean a much weaker economy that we're just not seeing yet? I mean, do you have to have faith that it will work as it has in the past? And if so, stock buyers don't seem to have that faith, which is sort of this interesting conundrum that you're seeing right now. I'll give you an example. Front and foremost, Target, it came out this morning with earnings that were pretty poor, at least if you look at some of their forward projections. Full year adjusted earnings per share expectation of $7.75 to $8.75 versus an estimate of $9.25. Those shares were up as much as 5%, now up about 2%. People looking past the negative guidance and saying, you guys are going to be great. I mean, basically, it seems like you've worked through some of your inventory issues. Zoom Video surging almost 7% at one point, up 7.6% after yesterday's earnings that showed better than expected fourth quarter results as well as a forward outlook. So I guess people are still using Zoom, even though, perhaps people are trying to get back to the office. I don't like Zoom. I've got to be honest. Do you guys like Zoom?
I don't like Zoom either. Barely used it, though. Got away with that.
Yeah.
I am, people go blessed. I am so blessed.
You know how I feel about meetings?
I've used it 3
times.
times.
I've got no time for meetings.
Well,
I hate meetings.
My issue is that gap when someone speaks and then it kind of pauses the other side. So people are constantly tripping over each other. It's like,
Do you know that stock's down from the high of the pandemic?
Oh, yeah. It's just been
from
crushed.
2020. That stock's down 87%. Based on the closing price of yesterday.
Well, people thought that Zoom was the new Office, and then it wasn't the new Office anymore. And
the new Office, it was going to be the new Office.
I mean, essentially, everyone was going to work from home, and kids were going to do school from Zoom, and everything was Zoomy. But also, I'm looking at Chevron, just to give you a sense, because we talked about their share buybacks and the potential repurchase stock rate of $17.5 billion annually. This despite the decline that we've seen in oil prices. And this really goes to the existential angst of oil companies. Despite some of the pushback that we've been getting, you still are seeing them not invest as much of their cash in production because with their fossil fuels in 10 years.
They just have huge cash flow. They went from, I think it was $13 billion up to $30 billion, and Mike Wirth is rewarding shareholders. I know it's a raging debate, but to me, it's intelligent use of cash, whatever the firm is. There is a debate, as John, you mentioned with Warren Buffett. The basic idea here, are you buying shares at the top of the market or are you buying shares cheaply? I don't have an opinion on that, but that's the only real debate about shareholder buybacks other than not investing, but they're investing, right?
Do you want the Buffett quote? Because it's a pretty good quote, isn't it? from the investor letter over the weekend. When you were told that all repurchases are harmful to shareholders or to the country, or particularly beneficial to CEOs, you are listening to either an economic illiterate or a silver-tongued demagogue.
Yeah, Mario Gabelli.
Pretty punchy stuff, isn't it?
Gabelli is heated on this as well. Is it? And to me, it's just all about taxes. I mean, that's all there is to it. We'll talk about that later. Over to the bond market, I'm going to ask a question I have never, ever asked. I can do that with Robert Tipp, Chief Investment Strategist at PGIM. PGIM is a really interesting house, including taking down all sorts of Morningstar awards in total return and fixed income over the years. Robert, I want to talk about the next shoe to drop in the fixed income world. So an open question. Not so much negative, what keeps you up at night, but simply what is the identifiable next shoe to drop out 6 months in your world?
Yeah, I think that's the thing that everybody's wondering about that's not going to happen. You know, the fixed income market was, for all practical purposes, murdered in 2022. We've had yields rewound decades back up to really substantial levels. And the markets clearly recognize the value. And whenever volatility has gone down, money has started coming back into the market. So I think that's why, while people are still looking for the hard landing, the excessive boom with too much inflation and where the next disaster is going to be, spreads are grinding tighter, and long-term rates, are not making that much progress higher. Even the 10-year bond, with the numbers that they're putting in there, is just reaching, slightly exceeding levels that were hit last year. So I think, we're going to be in the meat of the distribution rather than the tails here.
All right, well, that's a really nice way of putting it. And to carry that forward, all of a sudden what's changed is you have a coupon to work with. Are we reverting to institutional behavior of 2006 and before because we have a normal math market and a normal coupon?
I don't think we are yet. I think that investors maybe have not completely wrapped their minds around the fact that these are substantial returns in fixed income. So I think there could be some asset allocation to happen there. I think the other education that's going to take place over the next couple of years is the trade-off between cash and long-term fixed income. I think that eventually at some point in the future we will see inflation coming back down to target. We may see some gentle drift back down in rates, but the people that stay in cash are not going to lock in the returns for the long term. So I think, that's the big trade-off here is, exactly when do you want to lock in the rates as opposed to have the certainty of, 4%, 5% on your cash.
When is that time?
I think we're pretty much in the zone. I think markets are having a very hard time pushing the 10-year Treasury over 4%. I think we're going to be centered around 4 until and if, as if the Fed gets above 5, and then you may see some pressure up towards 4.5. But we're pretty much in the topping zone. I mean, we're as low as 0.5% in the depths of COVID. We passed up through the 2% averages of the post-GFC environment. And we're now back to this century pre-GFC levels. And I think we're going to be kind of range bound at this level.
What's your concern level about the potential for increased defaults? It's been sort of shocking to me that 4 years ago, people were saying when rates would rise and inflation ticked up, then all of a sudden you'd see this massive default cycle. And now people are saying, actually, the companies look great. They've locked in term structures that really immunize how much interest they'll be paying for a long time, and there won't be that many defaults. Do you agree with that and lean into riskier credit as a result?
I think that, yes, I agree with that. I think that the performance of credit has been better than some have expected. But companies have really been in the driver's seat since the bottom of COVID. They've been very conservative in their activities. They have held themselves back from overinvestment and the excesses that you've seen in so many cycles in the past. And I think, do you go into deep credit? I think it's a point in the cycle where you could risk that. But I think actually in the, you don't have to reach to get the value. I think there's more value in intrust sector and generally speaking, being over allocated to credit without reaching into things that have excessive downside risk.
When was the last time that you were this excited about presenting a potential portfolio return target to your investors, where you could basically say, look, you don't have to extend that far and you could easily get 8% on your overall portfolio? I mean, have you really had any kind of parallel to this moment?
No. All the times in the past when rates had popped up to this kind of level during my career, so going back, longer than you would want to think, to the peak in interest rates, there's always been a secular bull market aspect. And so there was no real trade-off. If rates had had a big back up, it was time to extend duration and go out to the back of the curve. It's a little bit more difficult case to make now because I think we're going to be range bound. I think people don't realize that the vast majority of the time historically, rates have been at these levels. So I think we're going to be in a relatively steady state. I think that the increases in return for extending duration are going to be more subtle. They're going to be realized over long periods of time. But there is no exact comparable period looking back over the last handful of decades.
Robert, this is such a massive change for you. You and I have talked together for so long. Coming out of this pandemic, this is a real change for you and the team. How will this change your approach to fixed income?
Yeah, absolutely. It has not changed our approach to fixed income. And, we've always looked for the high information ratio trades, and there are high information ratio trades in the interest rate environment, given this curve shape, whether it's in relative value or whether you're looking at the excessive confidence the market has in terms of what exact form the course of the Fed funds rate is going to take. Those opportunities are there for positive carry that will profit from a reversion to a more normal shaped curve. And so there's been absolutely no difference. We've always looked for the fundamental value in the market, and that's no different now than ever.
Well, the yield environment is certainly different to what we saw a decade ago for much of the last 10 years. Robert, thank you, sir. Just phenomenal. As always, Robert Tipp there of PGIM Fixed Income. We're still trying to, I think, struggling to internalise these post-pandemic realities, Tom. Still, particularly in this fixed income market.
Between Whaley and Robert Tipp, I mean, you're getting a real sense of that. The people, again, making it up as we go.
That was a clinic, that's for sure. 8:30 Eastern Time, David Page of AXA Investor Management. That's going to come up in about 50 minutes or so. Up next, we're going to talk about energy. Crude right now, 77 on WTI.
Keeping you up to date with news from around the world with the first word, I'm Madison Mills. The Biden administration has a warning for companies lining up for funding from that U.S. CHIPS and Science Act. That money will come with major strings attached. There will be restrictions on investing in other countries and a limit on stock buybacks. The $39 billion in incentives are meant to boost semiconductor factories here in the U.S. And Fox chairman Rupert Murdoch testified that Fox News commentators did endorse false claims that the 2020 presidential election was rigged. That's despite Murdoch's immediate doubts about the conspiracy theory. Murdoch was questioned in a lawsuit against Fox by Dominion Voting Systems. Fox has denied it promoted false claims about the vote. And oil headed for its fourth monthly loss in a row. West Texas Intermediate is down about 3% in February. Investors were optimistic about rising demand in China, but that's been eclipsed by concerns over tighter monetary policy and increasing oil supplies here in the U.S. And home buyers in the U.S. are increasingly paying in cash. According to real estate data analytics firm Adam, the share of all cash deals rose last year to the highest level since 2013. It was over 50% in 13 cities, including Atlanta. Meanwhile, the number of institutional investors declined, suggesting more regular buyers turned to self-funding to avoid those higher mortgage rates. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Madison Mills, and this is Bloomberg.
Consumers have consumed 13% less energy than they would otherwise have done because they're trying to economize. There's about another 10% saving coming from the weather. So we've consumed about 23% less energy this winter as a result of the weather and people changing. So that's really helped the supply-demand situation and left us in a much better position at the end of winter.
One of the biggest oil traders, if not the biggest oil trader on the planet, Russell Hardy there, the Vitol CEO. Crude closed out last year at 80.26. First trading day of the year, it closed at 76.93. WTI right now, 77. And I'm sure many of you are asking, China reopening. What reopening? Where is it in the commodity market? It's not in crude. 77 at the moment on WTI, up by about 1.8%. We can discuss a little bit more about that in just a moment. I want to talk about the bond market. Yields up in Europe. That's where it started a little bit earlier, with French inflation, Spanish inflation coming in hotter than expected. Yields up here too by a couple of basis points on the 10-year, 392.98. Another read on Eurozone inflation later this week. You get German CPI, you get this regional breakdown through the morning, tomorrow morning. So look out for that. Euro dollar, Tom, just about unchanged at 106.11, and futures with a lift up a third of 1%.
Interesting to say the least. And John, help me here. I think the major theme today, which is really off the American radar, is the inflation trends in Europe are just stunning.
Without a doubt.
Can you imagine if we see those here?
The stickiness of it?
Yeah, not predicting it.
The problem is they were hoping it would fade, and it seems to be accelerating at certain places.
I don't know if we mentioned it. I don't think we have yet, but Torsten Slok out 40 minutes ago or so with a little bit of a whisper of housing good news and disinflation.
Hey, Neil Dutta, Lisa, Neil was talking about it.
Is this good news? I don't think it is. I mean, yes, it's great for people who want to sell their homes, but what you're seeing is a bit of a resurrection of some of the sentiment within the housing market, and Torsten Slok was putting out charts showing that. So mortgage rates go down just a little bit, and everyone floods back to the market, which indicates they haven't really diminished that underlying spirit and fervor.
Well, we'll see. And we got Case-Shiller today as well. Always dated, but nevertheless important.
I think it's the S&P Core Logic Case-Shiller Index, isn't it?
Very well done.
Thank
you.
you.
That's beautiful. 20 City.
Just to clarify.
Stick a 20 City in there.
Carl Case of Wellesley and a guy named Schiller at Yale. They're the ones that put it together. It's hugely valuable, even though it is a little bit 60 days, I think, dated as well. We've always taken pride, particularly with Will Kennedy, of our hydrocarbon coverage, usually centered around economists. Think of Ed Morse, maybe, at Citigroup, or a guy named Curry at Goldman Sachs. But it is on the bid and the ask, and particularly looking out to the future, where a lot of information can be gleaned. He's legendary at Mizuho Securities. He has a privilege of working with Dominic Constam and Mr. Rasciuto as well. Bob Yager joins us this morning. Bob, you've been doing this a few years. Do you have transparency in knowing where the bid and the ask is? Is your market running normally?
It is running normally. We're stuck in a range, unfortunately, that we've been in since the end of November. We've been trading between $70 and $83 for 4 or 5 months now. So we are trapped in this range. It's the China story versus the inflation story, or the fight against inflation story. We have been stuck in a market structure known as contango, where the front of the curve is cheaper than the second month. And that's a weight around the market's neck. It just cannot get out of the mud. We're stuck in the mud here because of this contango market, and the proof is in the pudding. We were in basically a $10, $12, $13 range for months now.
Bob, you mentioned that tug of war. Let's talk about one side of it, one part of it, China. Has China just not reopened in the way people expected at the start of the year? What's your take on things?
I mean, you can't go from 0 to 60 in 0.1 second. It's going to take a little bit of time. A lot of the big barrel counters, the International Energy Agency in particular, who, in my opinion, is probably the most reliable, they're looking for Q4 for that real growth, and I would tend to agree with that. Like I said, it's too soon. We were just talking a couple of months ago about demand destruction in China, and now we expect them to be carrying the world on their backs to the promised land or something. It just doesn't happen that quickly, in my opinion. I don't think it's fair to the Chinese to expect them to be in that position either. But they'll get there eventually. It's just not going to be tomorrow or anytime in the near future.
Bob, how tight do you expect this market to be? There's been some talk that maybe Russian supply has just surprised to the upside, and that can offset some of the additional Chinese demand. How tight do you think it will be when that Chinese demand does eventually kick in?
I think we could approach $100 again in Brent. I don't think we're going to blow out to $130 like we did during the early days of the war, or into the war. But I think we could get to $100 based on supply and demand dynamics. Another problem is, though, you got to keep in mind, here in the United States, storage is at a 22-month high. We have a lot of crude oil here. because we had a really warm winter, and distillate, that's heating oil basically storage, is it just never developed. And the relative price of heating oil to crude oil started to tank. If you don't need the heating oil, you don't need the crude oil to make heating oil. So that dynamic has really played out in a negative way as far as the whole complex is concerned also. Gasoline may be able to come to the rescue by Memorial Day. So there is some hope there also that will put a bid in the market. Keep in mind, below $70, it's kind of the abyss. So it's a very, very important level versus WTI versus $70.
Heading into the abyss, you're starting to sound like the rhetoric that I can relate to. I am curious, though, Bob, as you start to talk about the potential for further declines, how you understand the driving season in light of electric vehicles. And I say this because it's kind of muddied the picture a little bit when people talk about some sort of downturn creating a negativity for oil prices and an upturn positive growth, causing oil prices to rise. We're not seeing the same levels of demand play through. Is it because of EVs?
I don't really think so. I think it's more of it's chipping away every day. Make no mistake about it. There'll be a time in our lives when it will be the dominant force versus gasoline. It will switch the other way at some point, but it's not going to happen in the next year or two. Fisker announced that they're going to put out a pretty big number of vehicles later in their production cycle here yesterday. So that's a brand new big chunk coming to market. But it's, for lack of a better word, it's kind of a spit in the bucket right now, as opposed to the inflation story where people are worried about the amount of money in their pockets and they're reluctant to go out and drive across the universe because it's going to cost them a pretty good penny. It could cost them significantly more as we approach Memorial Day, as long as price doesn't rally like it did last year to $5 and basically kill the golden goose in the process.
Bob, just before we let you go, we were talking this morning about Chevron's recent share buybacks. Do you think this is a sign that a lot of the oil majors just really don't see any prospects for more investment and just see shareholder returns as the best use of their cash?
I think there's a little bit to be said for that. You got to keep in mind they were in a pretty tough position for several years. This is a mini golden age for the oil producer, and they learned their lesson from increasing production at every opportunity, and they realize that that's not the way to run the bottom line. So they are now on track because they have adopted this formula of buybacks and dividends, and it's working for them. And their obligation to shareholder is done a lot better job.
Remember, President Biden said at the State of the Union, we need crude for at least another decade, at least another 10 years.
Yeah, what did Emery say? That was going to be rolled out and all
at least another 10 years.
Republican.
And then I think he said after, when people started laughing, more than that. Of course, it's going to exceed that. Bob, thank you. Bob Yorga there from Mizuho Securities. Thank you very much. Catherine Mann of the Bank of England. Moments ago, the hawk on the MPC saying this: lower energy prices might push up consumer spending. Tom, we've heard that a few times.
Yeah, and, we have a huge respect for Dr. Mann, and I think that's Micro 101 that she used to teach at Brandeis, and I believe before that, I can't remember the details on it right now, but the answer is she's got the chalk in her hand, and she's at the chalkboard telling us what's going to happen.
Yep.
That's not the value add. The value add is a length of time we may see this. They're all trying to slow and break the economy, and as they B-R-A-K-E the economy, they may B-R-E-A-K the economy, and us as well. That's the challenge. Like that, I did that.
They're struggling to get CPI down. Let's put it that way. That's the bottom line. In the last week, there's been a story developing between China and the United States. The United States has been very transparent about this. They are worried that China may support Russia's war effort directly with lethal aid. Every single day almost, we've heard from one official or another talking about this. It's Secretary Blinken now speaking in Astana, Kazakhstan, and saying the following: the Xi-Putin No Limits partnership, Tom, is, quote, a real concern.
I'm going to go, and I've been asked this like 5 times, John, in the last couple of days, and my answer is our intelligence capability knows a lot more about this than anybody's letting on. And I'm willing to say to authorities, okay, what do you know? Get to work. And we seem to hear from the Secretary of State they are monitoring this closely. And also what he said on sanctions. They're going to monitor the Dan Tannenbaum world, the efficacy of
Well,
sanctions.
the White House has said there would be consequences. And the question, obviously, inevitably, that's being asked is, what are the consequences?
Bramo could get on the list. I mean, Bramo could be on the sanctions.
Well, sanctioned.
Yeah, Russian sanctions.
With Dan Tannenbaum. I'm not
From
sure where
what?
that came from.
Disney
What's she done?
World?
What's she done?
Sanctioned, no joy.
The Fed wants to send a message that rates are going to stay elevated for an extended period, maybe as much as a year.
The nature of growth and how the slowdown is impacting the economy is likely to be uneven.
Most of the numbers are stacking up towards a second half recovery.
It looks like the Fed's doing the right thing, and that counts the most. It's the end of free money.
This is now about fiscal policy. We're entering the fiscal policy decade.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on radio, on television. It's PowerPoint Tuesday. We welcome all of you here. Futures up 14, a nice lift to the market. We've been focused on inflation. We've done a lot in the markets. And John, a 118-page PowerPoint just landed.
Have you read it?
I've skimmed it.
I haven't read it.
Page 54 is where the story begins.
You managed to get that far already?
Well, I've done the surveillance skim, we call that, as well. Shonali Bassick with Mr. Solomon on an eagerly anticipated statement of the Goldman Sachs future. We'll do that later, but just with the headlines out now, I'm going to say, John, they're pretty vanilla headlines. They're the spirited effort of a firm trying to convey the message.
What headlines can you see? Because I haven't got any yet.
GS Equity CN is the secret code.
To reduce unbalanced sheet investments to $45 billion. It's a reduction next year, setting a target of $10 billion for management fees. Just going through some of the goals of the company. Really, the question is going to be about leadership as well as sort of their overall strategic targets.
Yeah, and what I'm going to do is make this real clear is the keyword is scale, like at Target and like the retail earnings that we've seen. And frankly, John, to your shock over ECB and a 4% potential rate, it's the scale of the effort. And they talk with their troubled banking firm. They need scale to make this work. Is that true of everything we deal with on surveillance?
Let's start with rates. Total game changer. Total game changer.
Total game changer.
To be thinking about the ECB at 4, maybe the Federal Reserve pushing 6, unthinkable 12 months ago. And that's what the bond market and all of these companies have got to grapple with, Tom.
Yeah, it's going to be interesting to see. And the time, I think Chris Verone, frankly, nailed it here with this just an absolute soup out there. Wei Li today, a new regime. Is it a new regime for everyone we speak to?
Wei Li essentially answered Lisa's question, which is she didn't see reinvestment risk going at the short end, which is a short way of saying ultimately we think this new regime is here to stay. High yield's going to be with us for a while.
That, to me, was one of the biggest takeaways. It was pretty shocking. And if it isn't just going into the longer end of the curve, it's going into equities, particularly in emerging markets. In other words, there are other areas that will be good reinvestment moments. It's better to have cash and be able to be nimble at a time when you're changing your view 2 times in 2 months.
Some of this is the economic data we see. Let's review this, John. I think it's so important. Jobs Day is not normal this month. It's a bit delayed, and tomorrow we get the Ferro statistics. You like the ISM tomorrow is the first real look of where we are.
So the so-called PMIs have been sub 50 for a while. And I think the question we were all asking is, what is the market doing up here? And the PMIs are sub 50. Something's got to give. Either the market's got to come down or the PMIs have got to recover. Both happened. The PMIs are north 50 again, Lisa, and I think that's indicative of an economy that's doing better than expected. And also, as we look to February, this is going to be an early read on the month of February after seeing a fantastic January with one big question for most people, I think, in this market at the moment. Can we confirm the January data with similar performance in the month of February? And there might be some indication that maybe we can.
So is good news bad news? And this is sort of the question, right? And I think we can throw it away because people right now are saying good news is good news. Stop it already with all the pessimism, because basically that's what you're feeling in a stock market that has more fear, Tom, of missing out than necessarily some view forward of pessimism at a time when they're willing to rally, even with a negative look for the year ahead.
We're going to be focused here on what we do, and we're going to look at the data right now, and then we're really going to dive. I'm looking at the Goldman Sachs PowerPoint, John, and I'll be honest, it's a lot of managed happy talk, and we got to look beneath it to see.
Isn't every investor day
managed happy talk? The bottom line is what is written. I'm a big believer in that, and I'm looking right now at page 55, where, quote, we're going to manage through a complicated credit environment. You think? That's the challenge they have.
Well, I think actually
it's
the fact that that challenge hasn't emerged in the way that perhaps we thought it would have just maybe a year or so ago. If you told me the Fed was going to do what it's done, the ECB is going to do what it's doing, and we wouldn't have what we've seen ultimately, I would have expected spreads on the periphery in Europe to be a whole lot wider. I would have expected credit spreads to be a whole lot wider than they are right now, and that's just not what's happening.
Well, market's clear, and the answer is corporations adjust like the inventory of Target out the door. Let's clear with a data check right now. I don't really know what to make of it. I'm going to go to 210 spread, which is round trip. We were at 90 basis points for a cup of coffee, and then turned back around and had less inversion, John, and we come back now to negative 87 basis points. It's a round trip on inversion just since Friday.
Well, let's take the 2-year piece of that. Tom, just accelerating over the last month, just a massive lift on a 2-year through 480. On a 10-year, ultimately getting closer and closer to 4%. We try that again, up a basis point at 392.78. And to your point, the next big stop is payrolls next Friday, 2 Fridays away.
Sarah Malik joins us right now. Let's jump into it, a chief investment officer at Nuveen. Sarah, what has changed in your outlook in the last week or so? We have whipsaw. We are in shock, back and forth. What has changed in the Nuveen placement?
Markets are adjusting to the fact that the Fed has more work to do. And this is monetary tightening is not taking a bite out of the economy. This is bad news for inflation and bad news for the market. So I think the markets generally stay in a trading range and the Fed stays in a holding pattern with rate hikes and then a pause until we can get some kind of break on inflation in terms of wages or shelter or spending on services. And we're just not really seeing that yet. And that's why we're generally thinking that the market's going to have trouble continue to move to the upside, likely a trading range or downside risk from here.
Let's talk about the Wei-Li point that basically it's not worth necessarily going into the long end of the yield curve at 4% if you can get 5% at the short end, because you could potentially get higher yields and you could potentially get a better opportunity elsewhere. Do you agree with that stance?
I think generally that is going to be the case going forward, with now about 3 hikes getting priced into the markets for the Fed. And then again, no rate cuts in the future, likely a pause. And then if inflation doesn't break, you could even see more hikes from there. I think it is the short end of the yield curve that's going to continue to look more and more attractive versus the long end.
So where are you looking for in terms of getting some sort of returns other than the short end? Are you starting to see opportunities in industrials, as we were talking about earlier? Are you starting to see opportunities in retail like Target that came out with expectations that were disappointing, but everyone still seems to be cheering?
So starting with retail, I think, consumer and the employment markets are going to be the piece of the puzzle that determine the depth of and the timing of a recession. So consumer, I think, is at risk. That's not an area that we're incredibly interested in. We're more on the conservative side, looking for quality companies and also some beta outside of the U.S. So starting in the U.S. with quality companies that tend to grow their dividend, they tend to have strong balance sheets. They're more recession resilient, provide you some income protection going forward. So this is everything from infrastructure companies that are backed by utilities and waste management, all the way over to companies like Linde or Coca-Cola, which tend to be a bit more defensive in a volatile market. Now, outside of the U.S., we think emerging markets look attractive because of valuations there, also the dollar, which may not be as strong as it was last year, and also China continuing to reopen. I think EM finally has a tailwind. You could see some upside there. So kind of a balanced bet there, but staying a little bit more conservative in the U.S. because of the continued rate hikes that we see and the potential for a recession. Right. That may be delayed, but likely still comes.
How does use of cash play in? I mean, the Journal's got the article out on 1 trillion share buybacks. We saw Chevron, Mr. Worth, make a statement today. Define use of cash for Nuveen.
Well, first of all, just going to look at energy companies, I think that we've seen this with them for quite a number of years. They are more focused on returning cash to shareholders than on pulling barrels out of the ground. That's keeping supply tight for energy companies. And we agree that oil prices likely have more upside because demand remains reasonably strong, supply remains tight. Cash is an interesting asset class in the sense that it is paying good yields. My caution in terms of cash, though, of course, is that the markets tend to price in a recovery well before we see any of the data. So it's a timing issue. And when you're trying to time the markets, usually that's generally a loser's game. So while it's important to keep some cash in hand, I would continue to look for areas where you see good value. Now, these are areas like non-U.S. markets, particularly emerging markets, also in alternatives. Private credit tends to be more resilient during a recession. If you look at historical downdrafts in the markets, private credit tends to hold up better. Mm-hmm. And then conservative equities like dividend growers tend to be more resilient. Yeah. That's where I'd be looking to put my cash.
So I'd be rude if I didn't ask the Nuveen heritage. Should we take advantage of municipal bonds this morning?
I mean, fundamentals versus the valuations of municipal bonds are at a mismatch because of the strength of the economy and the tightening that's not impacted the economy yet. Municipalities still look very strong. So fundamentals are strong, valuations look interesting. You're seeing total returns in municipal bonds and also areas of taxable fixed income such as leverage loans that still look very attractive to us. And again, that's why it's important to make sure you use your cash wisely, because you are seeing entry points that you haven't seen in years or even decades in many of these asset classes, such as fixed income.
Sarah, I've always wanted to ask you this question. How did Nuveen become the largest manager of farmland assets on the planet?
You know, this is a historical asset class that we've been very heavily invested in all the way back to when the TIA days as our parent company. It's an asset class that we thought was very resilient. It's a great asset class as a hedge to inflation. So it's just a very strong asset class and important, obviously, to society. We've built it over time, and it's become, I think, in a world where equities and fixed income have become very correlated, alternatives such as farmland have been a very important piece of investors' portfolios.
And they continue to be correlated this year as well, even when we were expecting that to break. Sarah, just wonderful as always. Sarah Malik there of Nuveen. That's been a theme of the month so far. Bonds falling, equities falling, yields up, stocks down. How many times have we woken up and said yields up, stocks down? Equity futures just about positive this morning by 1/3% on the S&P 500. We had Target a little bit earlier. The outlook not great for the first quarter or the year ahead. We've got a Goldman Sachs Investor Day kicking off in New York this morning, Tom.
We do. And what we're going to do with surveillance is actually look at the 118-page PowerPoint. Shonali Basak leading us on it. Thank you, Shonali, for the first look at that. John, I've driven into it, and you need to get to page 63 to see the Mike Mayo page. The executives, all of them can come out with platitudes. It's loaded, as you would see at any investment firm, with the positive. One Goldman Sachs. It's like one surveillance. It's a big theme as well, one Bloomberg. But what I would say, John, is the money charts on page 63 to look at, where they look at very optimistically net charge-offs in the consumer banking rolling over and doing better towards 2025.
One Goldman Sachs.
That's
nice.
Front and center. That's page one. We get that page one and
cool.
Repeatedly throughout.
Shonali Basak coming up next to talk about it.
One Shonali Basak.
One Shonali. Just one Shonali.
One Shonali. Yeah, I like that. One Shonali.
Keeping you up to date with news from around the world with the first word, I'm Madison Mills. The Supreme Court hears arguments today on President Biden's move to slash the student debt of more than 40 million people. Republicans contend that the president is overstepping his authority on the move, but Biden put a freeze on federal student loan payments back on his first day in office. In the UK, Prime Minister Rishi Sunak's government has a hard sell. It has to convince politicians in Northern Ireland to back the post-Brexit deal reached by Sunak and European Commission President Ursula von der Leyen. Sunak spoke with reporters in Belfast.
I'd like to engage with the parties, and it's one of the key parts of this deal. It safeguards sovereignty for the people and institutions of Northern Ireland. It's what people were asking for, and the Windsor Framework delivers it. And I think it's more than anyone expected, and I hope that's why people can see that this is a really positive step forward.
The agreement is aimed at fixing a provision of the Brexit Treaty that effectively imposed a customs border in the Irish Sea between Great Britain and Northern Ireland. And Target turned in a strong fourth quarter performance, but the discount retailer offered a cautious financial forecast for this year. Target's outlook for fiscal year earnings is about 50 cents a share lower than the average analyst estimate. The chain's big problem is shaky demand for discretionary goods. And Apple suppliers rushing to move production out of China far faster than observers anticipated. That's according to one of Apple's most important partners. AirPods maker is one of the many manufacturers exploring locations beyond its native China. It's trying to avoid fallout from escalating tensions between Washington and Beijing. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Madison Mills, and this is Bloomberg.
We are moving back both in growth and inflation to what we would refer to as the old normal, that pre-COVID growth rate closer to what we saw in 2015 to 2019. And we think January, while it was certainly a good month, certainly a warmer and stronger month, will prove to be a bit of an anomaly as we go forward.
Great to catch up with Gene Sanuso there, the global head of fixed income at Columbia Threadneedle. What a year already for fixed income. We were told it was the year of fixed income, the year of the bond, and then the bond started to get in a little bit of trouble over the last month, particularly at the front end of the yield curve. Your 2-year much higher, your 2-year a whole lot softer, yields a whole lot higher. The story in the bond market looks like this right now. Yields just a bit higher on a 10-year maturity, up a couple of basis points to 3.94 in the FX market, from a high of 110.33 to a low of 105.33, all in a month, and right now 106.18, positive 0.1% on euro dollar, and futures trying to erase some of the monthly loss. Right now we're positive by about 1/3 Tom, on the S&P 500.
Yeah, but John, with all the angst we've reported in the whiplash, to see SPX at 4,001 sort of surprises me. Given the angst that's out there, I think I'd see a lower statistic.
Well, think about how much higher we were on things like the S&P 500.
Where were we? 42, 43?
And on the NASDAQ. The NASDAQ at one point this year, I think, was up like 17%.
Well, no, I take the point that we've given it back, but you know, I don't get the feeling of correction or bear market. What I get the feeling of is immense ambiguity.
So Marko Kolanovic of JP Morgan
What did he
put
say?
out a note yesterday. Well, he struggled with this market last year. He's struggling with it again this year. But ultimately, he thinks that the gap that's opened up between the bond market and equities needs to shut, and needs to shut with equities doing more to the downside. We've had this big correction in the bond market, yields up. Doesn't think we've seen enough with equities down.
Oh, we're going to have to see. Right now, what we're going to do, equities down, is maybe Goldman Sachs down. Let me cut to the chase. It's real simple. The book value doesn't match. Morgan Stanley 1.8, Goldman Sachs a lesser number. And the annual return over the last 10 years just isn't up to snuff. There are pressures on Mr. Solomon, but far more pressures on a name you don't hear from, and she is Stephanie Cohen. It's her job to fix what has now been called platform systems. On the platform at their Investors Day is our chief financial correspondent, Shonali Basak. Shonali, there's 118 pages here. I had to get to page 54 to the land of Stephanie Cohen. What have we learned this morning? What has the sell side learned about platform solutions?
It's official, Tom. It's going to take 2 years for this business to start to break even on a pre-tax basis. So it will take time to get through what happened here at the consumer business. There are a lot of questions about what they do from here with that business, but now they're trying to listen. There's no subtleties here down at Goldman Sachs today. You walk in the door and there is a big black sign that says forward. They want you to try to look forward even as they manage through that loss that they have to manage through the next couple of years. Where are they going to make money? They say that their asset and wealth management business is where they're going to get another $2 billion in revenue, bring that up to $10 billion in management fees next year.
Does the sell side, do the securities analysts there, and do Bloomberg Intelligence find integrity in their guesstimates out 2 years for platform solutions? Do they believe the PowerPoint charts?
Let me answer it this way for you, Tom, because today, to the extent that this is a scorecard for Goldman Sachs' management team 5 years into David Solomon's tenure, they give you the scorecard high up in the presentation. They've got you at the low end of their returns on equity, right, and their targets for the medium term, but they've missed on efficiency. That's where the rubber hits the road, and that is after 3,200 job cuts. So where can they find more efficiencies moving forward? Have they met all their goals? They haven't met one of the 3 of the goals that they set out. They have not, again, put out new goals. So the question here is, what do investors bite onto? And will this be a compelling enough day to give an investment thesis to investors above and beyond just meeting the goals that they've already set out?
What's the road ahead, I should say, for Marcus, for the consumer banking industry that Goldman Sachs has moved away from a little bit?
Listen, it's a tough environment because, as you guys were just alluding to, it's like not only loan losses ticking up, you also have marketing costs associated with businesses like that. Deposit betas are going up across the entire industry. There are big questions about it. But I think another question to ask here to kind of pivot to what the future is asset and wealth management. Goldman is trying to say that they're going to reduce their balance sheet, this $59 billion balance sheet at the end of last year, and alternative investments down to $45 billion next year and $35 billion over some period of time. They may give a bigger time frame soon, but is that enough to reduce the volatility that's associated with Goldman Sachs is a looming question, when really you have to look at asset and wealth management as the future. That's what management is saying it is.
How many questions are there among the analysts in the audience there about the potential leadership of Goldman Sachs going forward?
Certainly, there will be a lot of questions. Listen, we're about 10 minutes away from David Solomon addressing investors himself. The mood is quite tense. I've spoken to a few sell-side analysts here and asked them what they're going to ask, and they looked at me. They said, I have no idea. So there are a lot of questions that are looming. Again, this is a more than 100-page presentation on the progress that has been made under the 5 years here, or at least since 2020, since the last Investor Day, the first Investor Day ever held at Goldman Sachs. But here we are again, kind of mapping out the future once more. I will say one more thing. We haven't talked about just the main business in the room here, global banking and trading here, because that is the thing that they're going to start off with and tell you that maybe they should be rewarded more for that business that has gained share over time. You look at how it's performed, that's where they have been able to show their cost efficiencies at the end of the day. So we will hear from the top leaders in that business as well, very high up in the program.
So the oddest thing to me of this 118-page opus is I get the spin at the top. Any good company's going to do that. And I give Mr. Solomon great credit for the divisions that are doing well. As was discussed yesterday, they have a problem. How is Stephanie Cohen going to fix the problem?
And it's interesting, too. Remember, whether you're Stephanie Cohen or Mark Nachman, who is now running the global asset and wealth business, the succession story at Goldman Sachs about putting leaders up to a place where they can succeed. Stephanie Cohen, the woman that you had spoken about, was a former investment banker who had gone over to run this consumer business. And there was a time that she was seen as a rising star, potential successor one day to the helm of Goldman Sachs. Let's make no bones about it. And so, yes, what does it mean for her future here to turn around a story that they've given her a 2-year timeline now to make that business break even at the bare minimum? It's a huge question mark. And I would say the same for Mark Nachman, former trading executive who now has moved over to asset and wealth. And this is the new story for Goldman Sachs for him to lean into.
This is great, Shonali. Looking forward to your coverage through today. Shonali Basak there from the Goldman Sachs Investor Day. Tune in at 12 p.m. Eastern Time for Shonali's interview with John Waldron, the Goldman Sachs president, and Tom, the COO.
Absolutely original. You know, I don't know what to say about it. It's so important, John, as Shonali alluded to. So many parts of their business are nothing short of spectacular. Their place within Wall Street, their heritage within Wall Street. And they go off and do this experiment. You failed at experiment. Lisa's never failed. But you and I have gone down in flames with different experiments along the way. Humility's in order here. I don't see any humility in that PowerPoint about how they move forward with a troubled consumer experience.
By moving forward, are you suggesting it should be cut?
It's not for me to suggest it. My answer is they need to address, as Stephanie Cohen does in some very elegant charts, the line of revenues, the line of charge-offs, some kind of delta they can make along the way. And as Shonali mentions, at minimum, the delta's out 2 years.
There's been a question about the identity of a bank that traditionally was the heart of investment banking on Wall Street, right? Morgan Stanley and Goldman Sachs were the two investment banking behemoths that didn't expand into consumer banking in some of these other sectors. And so now the question is the fact that Morgan Stanley has effectively really expanded really well with their wealth management unit and how much that's really helped them. How much do we see some sort of similar move by Goldman Sachs? And if it's not outlined, what's on the flip side of that?
We'll catch up with Shonali again in the next hour. Looking forward to that. In the next hour, to count you down to the opening bow, Victoria Fernandez of Crossmark, Patrick Fruzetti of Rose Advisors, Andrew Sliman of Morgan Stanley as well on this equity market. That's all coming up in about 30 minutes from now. Going into all of that, equity futures just about positive still, up 0.25%. What a ride through the month of February as we close out the month of February, looking at a monthly loss for the equity market. Likewise for the Treasury market, with yields aggressively higher ever since we got that monster payrolls report for the month of January in early Feb. Your next stop really is going to be Payrolls Friday, which is 2 Fridays away. Get in the diary. It's March 10th.
Next stop is the Ferro 270-day report, March 31.
I can't wait for that to drop. Full outlook and our Investor Day coming up shortly.
One Ferro. Bloomberg Surveillance, Lisa Abramowicz and Tom Keene, John Ferro in preparation for a 9 o'clock hour as well. On the economic formula, there is everything domestic, and then there's a foreign bolt-on, which has to do with exports and imports in trade. It is time to really firm up the nowcasting of the trade side of things, and we do that with Michael McKee with ignored data that's important all of a sudden, isn't it, Mike?
Well, it's important because it is a component of GDP, and it does suggest that GDP may be a little bit smaller than it was in the nowcasts, because the advanced trade goods balance for January comes in at negative $91.5 billion. It's down from $89.7 billion in December. So it does look like that widened a little bit. We also got some wholesale inventories numbers. They fell by 0.4. That's interesting because that suggests fewer imports came in, and retail inventories rose by 0.3, less than in December, but more than forecast. So we still have some inventory build going on. But the perhaps the most interesting thing I can say about all this is this sort of wraps up the January data. And now that we're in March, we'll start to get the February data, which is what's going to play a much bigger role.
Where I wanted to go. Let's go to mere mortals like Stephen Stanley at Santander, just wonderful, or Stephen Rasciuto. I'm only quoting Stephen Economist today. Stephen Rasciuto over at Mizuho. And the answer, Mike McKee, is you say this is January data that we're wrapping up the end of February, and yet all anybody cares about is where we are March 31. Can they make an informed guesstimate now about this present quarter?
I don't think you can, because there's so much that's still outstanding, and the data that we have is for just 1 month out of a full quarter. And the Fed's got till March 22nd, so there's going to be a lot of data between now and then that will give us an idea of whether the January strength was the kind of thing that's going to be maintained or whether it's going to turn around, and whether the inflation numbers are going to ease off or not. But it's interesting to see all of the trading going on in the bond markets these days. And I know, Lisa, you've been all over it. But the idea that everybody is moving yields up, but that's based on what happened a month ago. What's going to happen
but
now?
Lisa, the yield here revisits where we were the other day. I think you weren't in, but the answers are the 10-year 395. Am I on the 4% watch in the 10-year yield? I'm not sure yet.
People have been, and also the 2-year yield close to the highest levels going back to 2007. What do you make of the fact that U.S. economic data has been surprising to the upside by the most since last May, at least if you take a look at the Bloomberg Economic Surprise Index? Is this because people's expectations were so low, or is it because the data is so good?
I think it's a combination of both. The expectations were low because people extrapolated out from previous episodes of what happened when we came out of recession, and the fact that it takes a while to get back up to speed, and people were nervous about spending and didn't spend. But that didn't happen in this recession, in part because the government gave away so much money. And what surprised everybody is the fact that consumers keep spending. Now, you remember the old days, we used to say, never stand between an American and a cash register. And that still seems to be the case, and they haven't run out of money yet.
Case Shiller at 9 o'clock. To me, it's always important, the memory of Carl Case and, of course, the wonderful Bob Schiller. Is it giving you good information, even though it's dated information?
It's giving us some information, but it doesn't help all that much because it is dated. But basically, it tells us where house prices are going. But unfortunately, it's delayed, and the Fed is looking forward, and they're looking at the more contemporary indicators to see what they think is going to happen. We'll see house prices hopefully continue to decline, but not a real impact on inflation until maybe May or June.
Michael McKee, thank you so much. Further economic data today, and then into a very, very busy, important March. Right now, and a joy to have in our studios is someone who was immense help through the pandemic. David Page is head of macro research at AXA Investment Managers. Great to see you here with us. I'm going to cut to the chase. I love one of the words you used, asynchronous, because that's what it feels like to me right now. Can we have a slowdown? Maybe not an NBE or recession, but can we have a, quote, media recession, whatever that phrase means, but some parts of the economy do okay?
Yeah, and I think the point that we make with asynchronous is that you can have slowdown in all of the economy,
but at slightly different times, and that might defy the NBER definition of recession. So what we're thinking, and we're getting some of it in the data now, we've got this sort of nuance coming through from trade, we've got this nuance from inventory, so that's probably weak in the first half of the year. The consumer looks pretty solid, though. And I think it's as we move into the second half of this year, particularly if we get the slowdown coming through in the labour market, that you'll see a softening in the consumer side. So typically, and this is why recessions are so difficult to forecast, at least in terms of timings, you get a synchronized slowdown, and that's when you see recession. If you get it asynchronously, one quarter's negative, then perhaps it's flat, then it's negative again. Remember, we've already had 2 quarters of negative growth that the NBER looked completely through.
Right.
And that wasn't a recession, that was just last year. So we could get a sort of sawtooth pattern of GDP come through, which would be a muddle through. And I guess typically that would be a soft landing.
Rounded up, German yields are up solidly today, I might point out. I'm looking at the 10-year yield, 3.96 as a roundup on the 10-year yield. Okay, that's one story, but the other story is the disinflation to come. Model your trajectory of U.S. disinflation.
So we think that headline inflation is going to fall back to around possibly just under 3.5% by mid-year. But then
by mid-year?
By mid-year. But then by the second half
by Bastille Day?
We are a French house, but so sometime around June, yeah. But then, as we move into the second half...
Okay, continue.
As we move into the second half of this year, we're expecting it to stay in that 3.5% to 4% passage. And that's why we've always said the Fed is not going to be in a position to be able to ease in the second half of this year, which markets have repriced quite significantly now. But we also think it takes a little while throughout 2024 to get that down, and they need to crack the labour market.
Well, here's the thing. When you're talking about an asynchronous recovery and a muddle through, isn't that problematic for getting inflation down? Isn't a muddle through eventually allowing certain industries to possibly see price gains that will keep inflation higher, even as you see sort of the year-over-year comps getting more complicated for the others?
Yeah, so to be clear, I mean, our view is still that we do see a mild recession. I stress mild, but we are looking at consecutive quarters of growth. But yeah, you're right. I mean, if we see this asynchronous, so growth is just slightly firmer than that, then the labour market doesn't loosen by quite as much, and that'll take a little bit longer for prices to fall. Ultimately, an asynchronous slowdown, a below-trend growth. This is the sort of the baseline that Fed Chair Powell talks to. We get below-trend growth coming through from the economy. The labour market eases a little bit, and that's enough to see inflation fall back. We think it'll be more than that, but no, that's exactly the risk.
We were joking earlier about how we have a show of people coming on and saying we have no clue, and then people ask us, and we're like, we have no clue because this is such a difficult time to really have a sense of what's going on. But I'm wondering how we can even be sure that that's enough to bring inflation lower, right? We can't, right? No. So if you have central banks that at least vocally are adhering to a 2% target of inflation, how do we know that we're not going to see a 6% Fed funds rate and a 4% ECB target, which is now priced into the market?
And I think that's the key risk. I mean, the central banks are pretty clear that they don't know either. I mean, we can roll back 15 months. We know the forecast errors that we all made, including the central banks, in terms of the inflation outlook. And the central banks seem to have learnt that lesson. But the point of that is that now central banks are using backward-looking information to judge when they've done enough with their forward-acting tools of monetary policy. So they're looking in the rearview mirror. They're not, I don't think, looking too much at inflation. The headline's obviously important, but it's the labour market that gives them the long steer as to inflation. And they're using that data to judge when they've done enough, when they know that rate hikes are still going to have a lagged impact on financial conditions going further forwards. And that, I think, is the biggest risk. If you're using backward-looking information to judge when you've done enough with your forward-acting tool, it sounds like a recipe for over-tightening.
Beautifully explained, and I guess the ex posti is becoming ever more ex posti, and there's some ramifications out there. We've observed, just as one theory, the Taylor rule is completely messed up right now. Torsten Slack over at Apollo models it near 9%, almost 10%. Bullard is saying, of St. Louis, is saying, let's go. There's others in the ECB saying the same thing. Let's go. Is there value to the urgency that Dr. Bullard speaks of?
Yeah, I think so. And I think, the move that you would get if you followed a Bullard-type approach is much more consistent, perhaps, with Fed history, that you could see the rates move a little bit higher to peak, maybe, even towards a peak of 6%. But then, once you reach that, you would break the economy. You would have to see rate cuts follow quite quickly. And I think what the bulk of the committee wants to achieve this time around is a peak that isn't quite as eye-watering as that, but it is held in place for a little bit longer. And that provides the restrictiveness that slows the economy further.
Before we let you go, the belief in lagged effects, is that enough for the Fed, for the ECB to pause at a level before they see the ramifications of their forward tools?
No, they need to see some impact come through, and they need to see that in the labour market, and particularly for the US. 512,000 is absolutely nowhere near enough to see a slowdown in economic activity, and earnings growth, average earnings growth, needs to be closer to 3.5, and they'll need to see that before they pause.
David Page, thank you so much. Greatly appreciated. In our studios here, David Page is with AXA Investment Managers.
He came here just to experience the one and only real snowfall in New York City. And so he was saying, wow, here, you walk through slush. No, we do not this season, but now we do. And I just wanted to point that out.
For those of you worldwide, we've had a snowless winter, and it's sort of on the edge of, where I grew up, this is the second week of April. Does this get in the way of opening day? Joe Feldman on Target, of course, working with Dana Telsey Advisory Group. Obviously, he's under review off the conference call, but a very constructive outperform. And he talks about loyalty programs, about the Target method, the execution method that they will have. We believe the company has multi-year profit recovery.
So just to give some perspective of what the optimism perhaps is stemming from, last year, Target had a decline of more than 30%, just to give you a sense. And Target's was about 2%. They had a 35.6% decline in 2022. So they're coming from a fairly low base, and their outperformance this year is coming after that. They were thought of as the gold standard for a long time in attracting people.
Execution standard.
The execution standard for service, for stocked shelves. Can they get back to that?
Oh, we'll have to see. I got 5-year dividend growth of near 11%. That's a starting point for a lot of institutional investors. And I've got a visible PE out to 24 of 18. So it's not the frothiness. Remember how frothy we were? The frothiness of a number of months ago has been taken out.
Well, I wonder if that's the reason why people are optimistic and they're out there buying shares, even though everybody else is saying, look, the world's going to fall when the Fed raises rates to 8%. No idea who that could be.
We will continue, but a data check is in order. I've got red and green on the screen. NASDAQ giving me a fractionally negative number as the SPX goes positive. A real churn to the market. We're going to blame that on David Page of AXA. Good to do that. The 10-year yield, 3.94%. We are watching yields.
Don't worry about
further
it.
Curve inversion, negative 87 basis points. Please stay with us. This is Bloomberg Surveillance. Good morning.
Keeping you up to date with news from around the world with the first word, I'm Madison Mills. The Biden administration has a warning for companies lining up for funding from the U.S. CHIPS and Science Act. The money will come with major strings attached. There will be restrictions on investing in other countries and a limit on stock buybacks. The $39 billion in incentives are meant to boost semiconductor factories in the U.S. And Fox chairman Rupert Murdoch testified that Fox News commentators did endorse false claims that the 2020 presidential election was rigged. That's despite Murdoch's immediate doubts about the conspiracy theory. Murdoch was questioned in a lawsuit against Fox by Dominion Voting Systems. Fox has denied that it promoted false claims about the vote. And home buyers in the U.S. are increasingly paying in cash. According to real estate data analytics firm Adam, the share of all cash deals rose last year to the highest level since 2013. It was over 50% in 13 cities, including Atlanta. Meanwhile, the number of institutional investors declined, suggesting more regular buyers turned to self-funding to avoid higher mortgage rates. And Chevron is showing confidence in its ability to generate cash even after a 30% decline in oil prices. The energy giant will repurchase stock at a rate of $17.5 billion annually starting in the second quarter. Previously, Chevron planned a $15 billion buyback rate. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Madison Mills, and this is Bloomberg.
We're going now into a period that I think will last probably the rest of the decade, frankly, with inflation in the 2.5% to 6% type of range. That creates economic uncertainty, creates economic volatility, and that creates dispersion.
Luke Ellis there of Man Group, finally with some pretty good data there. We'll have to follow that. Claire Carefully out of London. Good to see him there. Now with futures up 4, just a churn to the market is how I'm going to put it. With a VIX under 21 gets my attention off the economic data. Thank you, Mike McKee, for that. The 10-year yield 3.94%. I guess I'm watching carefully. What's the single statistic, Lisa, today you're watching?
Well, I'm watching the housing market in particular, and I think it's interesting following along with Torsten Slok. If you see a reacceleration or you don't see a decline as much as people think in housing prices, right, what does that do to this feeling that that component of the inflation read will go down pretty consistently throughout this year? Does that kind of defy that?
Yeah. In the beginning of our days, folks, of Bloomberg on the Economy and Bloomberg Surveillance, we thought we would speak to global Wall Street. And with great respect for the heritage of Goldman Sachs and for the challenges Mr. Solomon has faced after the tenure of Lloyd Blankfein, we thought we'd bring in an adult to actually explain what is in the ether, if you will, at West Avenue. Ken Leon joins us right now, Director of Equity Research at CFRA, truly with decades of exposure. Ken, is this any way to do business? I mean, CFA 1, you got a John Deere annual report. Maybe you got something else and this and that. And now we've got 118-page PowerPoints with a welcome from Mr. Solomon, a state of the franchise from John Waldron. Sonali Basak will speak with Mr. Waldron at 12 noon. Very important. And then we have one Goldman Sachs. Is this a branding exercise, or do you guys like you learn anything out of these soirees?
Well, it's great to be here. And Goldman is probably best in delivering messages and roadshows. I mean, that's what they do as an investment bank. And it's all about what they're doing right first, and then they're going to get the hard questions later. They speak to client franchise, and essentially this means that everyone wants to do business with Goldman, particularly the investment bank and also asset and wealth management. But what's interesting here is that there's a lot of hard questions about their strategy from 3 years ago to kind of button up with shareholders. They got a $30 billion authorized buyback, and they're talking about capital efficiency because they still are a regulated bank. It's a lot of questions today.
To sum it from an amateur, that would be me, folks. Stephanie Cohen shows up at page, I believe, 54. And what she basically says is, can you give us 2 years to work this out? Is that how you read it, Ken Leon? Is they're saying we need a 2025 hope and prayer?
So the Goldman brand supposedly was going to conquer the consumer market, and it didn't. And that might have been being too confident. And I think it's block and tackle the next 2 years, which will be profitability and return of capital. But the missing question here is that's great to be a great investment bank, but to be a great financial service company, you have to have recurring revenue, work through the cyclical parts of the market. And, we're talking about Schwab, BlackRock. These are stable, Morgan Stanley. Goldman Sachs still is an agent. It is really dependent on client servicing. That is always difficult to get a higher valuation. At the same time, I don't think they're going to make any big acquisitions. Right now, they just want to kind of have a calm where they can tell shareholders we're going to be more efficient, we're going to use less capital, and we're also going to find ways to be profitable and be smart, because they certainly weren't smart with their strategy before.
So there is a really big question within this, which is how are they going to expand more into that stable kind of business, the asset management that you're talking about, without making an acquisition, without making major investments, and without even laying out any kind of path to do so in this presentation?
100%. And when you look at their presentation, it's not going deeper and bigger in terms of asset management or alternative investments because that's very choppy. It's going to be more the wealth management side, the advisory side, or in areas like Larry Fink had, which was from getting the iShares with ETFs. So in time, when they need to look for a more predictable recurring revenue stream and a lower source of funding, it might be some of the custodial banks or even State Street, which has, a great ETF franchise. Goldman would never look this way, but the market is saying, even if you execute and you have several quarters of great earnings out of the investment bank, we're not going to give you a higher multiple. So that's really the conundrum they have. And I think those are the questions that are going to come up today.
There's also a question about its existing consumer-facing platforms. I'm thinking about Marcus as well as some of the credit card partnerships. And right now, Dow Jones, Wall Street Journal is reporting that David Solomon, the CEO of Goldman Sachs, was saying today that Goldman Sachs is considering strategic alternatives for its consumer platforms businesses, including Green Sky and their partnerships, their credit card partnerships with Apple and General Motors. Does this mean that they're going to reduce their footprint and sell some of those businesses in the near future?
I think if it's any of the businesses that require significant capital, the answer is yes. For others, which are transaction driven and they can leverage with partners, they'll certainly find ways that it could be incremental revenue and profit. But the big play is over.
Ken, I looked at the first grid chart, all of I think it's page 5 here. And they go against their leading peer, which is a Campbell's soup. It's like a minestrone soup of this firm, this firm, this firm. Baloney. The leading peer group compare is Morgan Stanley. To end this conversation, what did James Gorman get right?
James Gorman basically didn't go afar. So I have he was looking for adjacent markets like the workforce, 401k with E-Trade. He paid premium, but he got Legg Mason. He got established businesses versus sitting in a room and saying, we got the best brand, which is Goldman, and organically, we're going to create businesses. It's very hard to do in financial services. That's the difference, Tom.
Ken Leon, thank you so much. A brief there from the esteemed Ken Leon, CFRA. I love talking to people with decades of experience that have seen the Morgan Stanley really ugly period that they had, I'm going to guess 20 years ago off the top of my head. Maybe I'm a little bit off on that. 16 years ago, whatever. The cycles here that Ken Leon's lived is a big deal.
Well, there used to be this race, right, between Goldman Sachs and Morgan Stanley. They were basically neck and neck, and people viewed them in the same ways, and Goldman Sachs always was out on top. And that equation has shifted, right? And people are looking at that and wondering how much of that's driven by the global wealth management business of Morgan Stanley, and how can Goldman Sachs get that back? What is their base that is going to really drive that revenue over the long term? And they're saying that they're going to make the margins bigger in their wealth management unit. That's some of the headlines that are trickling through. But fundamentally, if it's not consumer banking and they're not going to make acquisitions, how do they do it?
I'm going to push back on that a little bit. I look at the PowerPoint, which I think nicely displays the Goldman Sachs excellence. I mean, Credit Suisse couldn't do this PowerPoint. Now, they don't have the platforms to deliver leading number 1 M&A, number 2 ECM, number 3. I don't even know what the alphabet soup is, but they're number 1 or number 2 in everything. But, and I think through the day and to hear from the different analysts such as Mr. Leon, is that but is platform solutions. And they've got to address that. I believe, I'm speaking, glancing folks at 2 quick PowerPoint pages, their but is, can you give us some hope and time to 2025? Is that modern Wall Street? I don't think so.
Modern Wall Street is banning ChatGPT.
Where are you going to be June 30?
Yeah. I do wonder also what they say about their tech investments. He did talk about, David Solomon was talking about how he's tried ChatGPT and played around with it a little bit, but now a lot of the banks are banning it, evidently. What do they do with artificial intelligence? How do they use some of these tools to make people more efficient, but then also get concerned?
You're worse than Ferro.
Well, no, but also prevent something from happening that they don't want to happen, because we don't understand all these neural nets to the same degree.
It's no different than TikTok or WeChat or the rest. This stuff is a absolute compliance nightmare.
The concept of artificial intelligence is not, because if used correctly, it could potentially put you on the front foot of new technology. So as a bank that's required to keep certain information safe, how do you be technologically savvy and efficient without compromising some of the safety and among other things?
There was a crypto headline out in the ether today as well. They're trying to deal with crypto as well. See, Lisa's just getting me going.
I try.
I'm going to have to take this surveillance nap. Well, after Sonali Bassick speaks to John Waldron is when I'll start Now, Sonali Basak in conversation with the president, the chief operating officer of Goldman Sachs. Mr. Waldron, look for that, the 12 noon hours. Stay with us on radio, on television. Good morning.